Welcome, learner, to our continuing lessons in human resource management. Today we are looking at motivation theories and practice of human resource management, where we are looking at classical theories of motivation, and we are looking at Douglas MacGregor theory X and theory Y. Now, this Douglas MacGregor is known for proposing theory X and theory Y, which are two assumptions about human nature, and theory X and theory Y on which are theory X and theory Y on how managers perceived and handled employee motivation. The theory X and the theory Y were developed by MacGregor in the 1960s. And these theories have extensively been used to inform decisions in management and in human resource management. So what Douglas MacGregor did, when it comes to theory X assumptions are the negative sides of the assumptions where some managers had the assumptions about workers. And theory Y is the positive side, according to MacGregor, that there are some managers who made assumptions that, for example, in theory X, that employees are inherently lazy, and these employees may dislike work, these employees must be coerced to work. So when managers have that kind of a view about workers, then those supervisors or managers will handle employees with coercion or a dictatorial management style. But on the other side, where an organization, a supervisor or manager views employees with assumptions of theory Y, then the theory Y is the opposite of theory X. And in theory Y, it is presumed that individuals will even like to do work so long as the environment is created to have them to work effectively. And what Douglas MacGregor proposed is that managers should emphasize on the theory Y assumptions to be able to create environments that help employees achieve their objectives. So we can have a look at theory Y and theory X, and then we see what were some of the assumptions that were made under theory X and theory Y. So here you have theory X assumptions. Theory X assumptions. Okay. Now, when it comes to theory X assumptions, as you have said, Lana, this is the positive side. Okay. This is theory Y, theory X. Theory X is the negative assumptions that supervisors or managers may have regarding workers. And what are some of these assumptions? What are some of these assumptions of theory Y? We have just indicated that in terms of a working environment, a manager may argue that the average worker is inherently lazy. So this kind of a manager makes an assumption that a worker is inherently lazy, for example. 2, dislikes work. 3, cannot take responsibility. 4, should be coerced. Should be coerced. So that means forced. Should be coerced or forced to work, should be coerced or forced to work. 5, will avoid work at all options. So if an employee has an option to avoid work according to these assumptions, a manager assumes that this employee will avoid work at all options, at all options, or maybe opportunity. So these are the kind of assumptions, and these are not all the assumptions. These are some of the assumptions that were proposed by Douglas McGregor, that when you look at a work environment, there are some managers, and these managers may have this kind of assumptions about workers. And when they have this kind of assumptions about workers, then these kind of managers are likely to adopt what is called a dictatorial approach to managing these particular employees within the working environment. Then, on the other hand, there is now the theory X assumptions. Theory Y assumptions. Theory Y assumptions. Now, the theory Y assumptions, this was the negative. So theory Y is the positive side. And when it comes to the positive side, according to Douglas McGregor, employees, the average employee will work willingly. The average employee will work willingly. So what is important is for the management to create a conducive environment. So according to McGregor's theory, when it comes to the theory Y assumptions, what are some of these assumptions? One, workers can take initiative for their work. Two, workers are responsible so long as the right conditions are created. Workers will seek extra, will take initiative and seek extra responsibilities. So what we are saying, Lana, if you look at the theory Y assumptions according to McGregor is arguing that this is the progressive side, and workers can be what is called highly ambitious. Creativity is inherent among the workforce and so on. So these are the issues. On the theory Y assumptions, if managers make an assumption that the average worker will take initiative for their work, the workers will be responsible so long as the right conditions are created. Workers will take initiative and seek extra responsibilities. Workers are highly ambitious. Workers are willing to be involved in decision making. And when it comes to performance, these employees are able to provide output. So what McGregor provided is that Douglas McGregor, as a note learner, McGregor indicated that it is the responsibility of management to create the right work environment, right work environment for employees to operate in. So according to Douglas McGregor, looking at theory X and theory Y, McGregor, Douglas recommended theory Y for progressive managers. So for motivation purposes, McGregor Douglas provided that managers who are progressive should be able to create a conducive environment, and once they create a conducive environment, the assumptions on which they should base decisions on regarding their workers could be the theory Y assumptions, and encourage employees to be able to perform. So those are the issues that surround the theory X and the theory Y assumptions in relation to a work environment. So we can go through this, learner, slowly again. We have looked at Douglas McGregor theory X and theory Y, and we have indicated that in the 1960s, Douglas McGregor is known for proposing two assumptions about human nature, and these two opposing assumptions were theory X and theory Y, and according to Douglas McGregor, these were the set of assumptions that managers perceived their subordinates or their work environments, and the kind of the managerial decisions they took were influenced by these assumptions. Then we have looked at theory X assumptions and indicated that the theory X assumptions were the negative assumptions that managers could make regarding their employees, and that would then influence the kind of management styles they adopted. And we have seen that the theory X assumptions may include: 1, average worker is inherently lazy; then 2, an average worker dislikes work; 3, an average worker cannot take responsibility for their actions within the work environment; and then 4, an average worker needs to be coerced in order to be able to work, and coercion here we have said is forced. And then number 5, an average worker will avoid work at all options or at any opportunity. So this then will make managers who are managing employees with this kind of a perspective to adopt a dictatorial or autocratic management style. So when workers are handled with that kind of a style, sometimes it may create challenges. So that is as far as the theory X assumptions are concerned. And when it comes to theory Y assumptions, this is the positive side. And the average worker, according to the managers who perceive workers this way: 1, workers can take initiative for their work; 2, workers are responsible so long as the right conditions are created for them; then 3, workers will take initiative and seek extra responsibilities; 4, average workers are highly ambitious; and 5, creativity can be inherent within workers or it can be cultivated. So those are the theory Y assumptions, a set of which some managers may perceive their subordinates and now be able to sometimes adopt what is called a democratic leadership style or management style to be able to get work done. And according to McGregor Douglas, it is the responsibility of management to create the right environment for employees to operate in, and Douglas McGregor highly recommended managers to increasingly adopt the theory Y approach to be able to create a democratic management style to be able to achieve both employee and organizational objectives and motivate workers to their level based in terms of they are based in terms of performance. So Lana, before we finish, I want to leave you with an assignment. And your assignment for the lesson today is describe Douglas McGregor's theory Y, theory X, and theory Y, as it is used in management. So Lana, this is your assignment. Describe Douglas McGregor's theory X and theory Y as it is used in management. So we have come to the end of our lesson today, where we were looking at Douglas McGregor, theory X and theory Y, and we have looked at the theory X assumptions and theory Y assumptions, and also your assignment. So thank you very much. We hope to meet in the next lesson.
Hi candidates, welcome to another session of Manifested Online Classes. We are still continuing the topic of group accounts, and in this session I want us to look on different types of group structure, and basically how we go ahead and prepare the consolidated financial statement in case of those different types of group structure. Now generally we have two types of group structure. The first one is called the horizontal structure, whereby the parent company do have a direct shareholding in a number of subsidiaries, and then we also have another type of a group structure which is called a vertical group structure. So in case of a vertical group structure, this whereby the parent company will be having a direct shareholding in a subsidiary and also having indirect shareholding in something called a subsidiary. So therefore maybe in this case we can say that there are different types of group structure, including number one, we have the horizontal structure. Number two, we have the vertical structure, and also number three, we can talk of the mixed structure, or basically the mixed group structure. So these basically are the different types of group structure. Maybe you can start with the first one, that is the horizontal structure. So when talk about the horizontal structure, this whereby the parent company do have or is having direct shareholding in a number of subsidiaries. For example, in this case, we can be told that A Limited, which is basically the parent company, has acquired some shareholding in B Limited, C Limited, and also D Limited. So mean that the parent company here do have direct shareholding in a number of subsidiaries. So therefore, you can say that this is where the parent company, remember also the parent company here is called the investor because it has invested in other entities. The parent company or the investor has a direct shareholding, in two or more subsidiaries, 2 or more subsidiaries, 2 or more subsidiaries. So the parent company here is having direct shareholding in 2 or more what subsidiaries. So a good example of a horizontal structure, let's assume that we have a limited, and which is the parent company, which is the parent company. So this company may have direct shareholding in a number of subsidiaries. For example, B Limited or A Limited may be having 80% shareholding in B Limited. A Limited also may be having something like 60% shareholding in C Limited, and also A Limited may be having like a 75% shareholding in another subsidiary, say D Limited. Now, this particular type of group structure, we refer to it as the horizontal group structure, because you can see the parent company, which is A, is having direct shareholding in 3 subsidiaries, B Limited, C Limited, and also D Limited. Now, in this case, when preparing the consolidated financial statement, we prepare them in the normal way, just like a case whereby the parent company is having a single subsidiary. Basically, what that means is that when preparing the group account, we add similar items of asset and liabilities of all the companies here. That is the parent company, B Limited, C Limited, and also what? D Limited. So therefore, you can say in this case, the group accounts are prepared in the normal way, i.e. by adding similar items of assets, liabilities, revenue, and expenses, of the parent company and its subsidiaries. So therefore, in case of what we refer as the horizontal group structure, the group accounts are prepared in the normal way. Basically by adding similar items of asset, liabilities, revenue, and expenses of all the companies within the group, the group. So let's move and look on the other type of group structure, which is number two, and that is the vertical structure. So in this case, when we talk about a vertical structure, this whereby the parent company is having a direct shareholding in a subsidiary, and then also having indirect shareholding in what we refer as a sub-subsidiary. So therefore, you can say that this is where a parent company is having direct shareholding in a subsidiary company, and also indirect shareholding shareholding in a subsidiary, subsidiary. So the parent company here will be having a direct shareholding in a subsidiary company, and also indirect shareholding in what we refer as a sub-subsidiary. So what do you mean by that? Let's assume that we have 3 companies, and A Limited here, we are told for example, acquired 80% of the ordinary shares issued by B Limited, and then in turn, B Limited here has acquired a 60% shareholding in another company here, which is called C Limited. Now, this particular type of group structure, we refer to it as a vertical group structure because the parent company here, which will be or which is A, is having direct shareholding in this subsidiary, and then A Limited, which is still the parent, is having indirect shareholding in C Limited, of which C Limited in this case is referred to as the sub-subsidiary, is referred to as a sub-subsidiary. Now, when preparing the group account, or basically the consolidated financial statement, in case of a vertical group structure, there are some important points which now the candidate must be able to know and which basically will help them in terms of preparing the group account of such questions having that type of group structure. So these are some of the important points to note. Number one, when dealing with a vertical group structure, these are some of the important points. Number one is that the candidates must compute the parent company indirect shareholding in the subsidiary. That is the first thing to be done. Compute the parent company indirect shareholding in the subsidiary. Indirect shareholding in the subsidiary. In the subsidiary. So how do we compute that particular parent company indirect shareholding in this particular subsidiary? So what we do, we take the parent company shareholding in the subsidiary. So for example, assuming A Limited, which is the parent company, has 80% shareholding in B, which is the subsidiary, and then B, which is a subsidiary or basically do have a shareholding of 60% in C. So to compute the parent company indirect shareholding in C, we take the parent company shareholding in the subsidiary, which is 80%, and then times the subsidiary company shareholding in the sub-subsidiary, which is 60%. So in this case, or here we are going to get a rate which is 48%. So here we say that the parent company indirect shareholding in C, or basically in the sub-subsidiary, is 48%. But in this case, despite or even if you get a rate which is less than 50%, still we say that the parent company is having indirect shareholding, or basically indirect control in C Limited, simply because A Limited controls this one, A Limited controls B, A Limited controls B, and then B Limited in turn controls C. Controls what? C. And because this controls this one, and this one controls this one, then in this case we say that this company here, that is A Limited, do have indirect control over the operating and financial decisions which will be made by C Limited, and also A Limited will be having indirect control as far as the composition of the board of directors of C Limited is concerned. So therefore, what you are saying is that provided this company is controlling this one and this one is controlling that one, even if you get a rate which is less than 50%, then that company is still a sub-subsidiary. What that means is that when preparing the consolidated financial statement, you have to consolidate, you have to combine, you have to add together similar items of assets, liabilities, revenue, and expenses of all the companies. So that is the first thing when dealing with a vertical group structure. Compute the parent company indirect shareholding in the sub-subsidiary. Number two is you need to identify the date, identify the date when the sub-subsidiary became a member of the group. So number two, we can say identify the date when the subsidiary became a member of the group, became a member of the group, became a member of the group. And basically that particular date is very, very important because when, for example, preparing number one, when computing the goodwill of the sub-subsidiary, you compute it on this particular date when the sub-subsidiary became a member of the group. And also when preparing something like the consolidated income statement, you prepare, or basically you take into account the result of the sub-subsidiary from the date it became a member of the group. That is why we are saying it is very, very important for you to be able to identify the date the sub-subsidiary became a member of the group. And actually, the sub-subsidiary is said to have become a member of the group on the later of the two dates between the date when the parent company acquired the subsidiary and the date when the subsidiary acquired the shareholding in what? In the sub-subsidiary. So therefore, you can say that the sub-subsidiary becomes a member of the group, becomes a member of the group on the later of the two dates, on the later of the two dates. So which are those particular two dates? We are talking of the date when the parent company acquired the subsidiary, and the date the subsidiary acquired the sub-subsidiary. So basically we are saying that the sub-subsidiary will become a member of the group on the later of these two dates. On the later of these two dates. The later of the date the parent company acquired the subsidiary. So like maybe let's assume that you're told A Limited acquired shareholding in B maybe on 1st of January, like 2021, and then B Limited acquired 60% shareholding in C on 1st of January 2022. 1st January 2022. Therefore, in this case, we are saying the sub-subsidiary will be deemed to have become a member of the group on the later of the two dates. The later of the two dates. The date which is later. Basically, the date which is later is basically this one. That is 1st January 2022. So therefore, when computing now the goodwill on acquisition of this particular sub-subsidiary, we compute it on that date. That is 1st January 2022. And also when preparing now the group account or the consolidated financial statement, we must also know that we are going to consolidate the result of that particular subsidiary from that particular date. That is the other important point when dealing with a vertical group structure. Other than computing the parent company direct shareholding in C, you also need to identify the date when the sub-subsidiary became a member of the group, of which you have said it must be the later of the two dates. So the other important point number three, point number three is regarding the cost of investment, cost of investment in the subsidiary, cost of investment in the subsidiary. So when talk about the cost of investment in the subsidiary, we are talking of the purchase consideration which was paid by the subsidiary in acquiring the shares of the subsidiary. In acquiring the shares of what? The sub-subsidiary. Now, this particular cost of investment in the sub-subsidiary usually is split into two parts. is split into two parts. So first of all, we compute the amount due to the parent company, or we compute, yes, amount due to a parent company. So when talk about the amount due to the parent company, this is actually the amount which is regarded or which is assumed to be paid by the parent company in acquiring the shares of the subsidiary. So how do we compute that amount due to the parent company? So this one is computed by taking the cost of investment in the subsidiary. We compute this by taking a cost of investment in subsidiary times the parent company shareholding in subsidiary. A parent company shareholding in the subsidiary. Parent company shareholding in the subsidiary. Like in this case, assuming we are told that B Limited, in acquiring the shares of C, may be paid 100 million. So how do we compute the amount deemed to be paid by the parent company? So we take the cost of investment in the subsidiary, which we are given there as 100 million, and then multiply that with the parent company shareholding in the subsidiary. So the parent company shareholding in the subsidiary is 80%. So in this case, we get what? We get 8 million. So this is the amount deemed to be paid by the parent company in acquiring shares of the subsidiary. And this particular amount which we get here is the one which is then used in the computation of goodwill. So we can say that this is the amount used by parent company in computing the goodwill of the subsidiary So therefore, that this particular amount here, we use it in computing the goodwill of what? Of the subsidiary. Then from there, we also compute the amount of purchase consideration due to the NCI. It is important to note that in this particular subsidiary company here, the parent company is having 80% shareholding, meaning that the remaining 20% of the shares in this particular subsidiary here are held by the minority shareholders. And basically we said the interest of the minority shareholders in a subsidiary, we refer to it as NCI, non-controlling interest. So therefore, what we do next here is to compute amount due to NCI. Compute the amount due to NCI. So how do we compute this particular amount due to the NCI? So we take the cost of investment, in subsidiary, and then we multiply that with the NCI shareholding in a subsidiary. NCI shareholding in the subsidiary. For example, in this case, assuming the cost of investment in the subsidiary is 100 million, so we have to multiply that with the NCI shareholding in the subsidiary. NCI shareholding in the subsidiary is 20%. So this will give us what? This will give us 20 million. So this particular amount of 20 million is then deducted from the NCI at the end of the year. So we can say this is deducted from NCI at the year end. NCI at the year end. So when computing the NCI at the end of the year, so that particular amount due to the NCI, we are saying, will be deducted from what? From the NCI. So therefore, it is very, very important to note that when dealing with a subsidiary, for example, in our case here, C Limited, number one, in computing the goodwill on acquisition of a subsidiary, we have to compute it on the date the subsidiary became a member of the group. Actually, we have mentioned something here to do with identifying the date when the subsidiary became a member of the group, of which that should be the data of the two dates. That is the first important point as far as the computation of goodwill of the subsidiary is concerned. Number two is that when taking into account the cost of investment in the subsidiary, we don't take the full amount. If, for example, B Limited had paid 100 million in acquiring the shares of C, that is not the amount we use in computation of goodwill, but we use the amount which is regarded to be paid by the parent, because it is the parent company here which compute the goodwill on acquisition of C. The goodwill on acquisition of C is not computed by B, because it is important for you to note that in a vertical group structure, here we can say generally we have two parent companies. So A is a parent company to B, and then B is a parent company to C. But this company here, that is B Limited, in accordance with IFRS 10, it is exempted from preparing the group account because it is a partially owned subsidiary by A Limited. The company which is
how are you over there? My name is Patrick Kamau Kamure. You are lecturer in taxation. Welcome to today's lesson of public finance and taxation, where we continue looking at the taxation of the business income, where if I can give you a little of recap of what we did, is that we said that there are three businesses that we need to see how they are taxed. One of them is the partnership, is the sole proprietorship. The other one is the partnership, and the third one is the limited company. In our previous lesson, we did the taxation of the sole proprietorship. So for today, we want to go to the next business, which is the taxation of the partnership. So partnership is where we have two or more people who come together to do business together, and they don't register their business as a company. Because of that, we normally say that partnership do not have a separate legal entity from the owners, and that will mean that when you are taxing the partnership, you tax the partners themselves, not the partnership itself, because it is not separate from the partners. They are partners, and the business, they are one and the same thing. So now we want to see how do we normally tax the partnership business. First of all, I want to write over there the introduction or definition of the partnership as I've illustrated. So we have partnership is a business owned by two or more people which is not registered as a company, and so does not have a separate legal entity. That is the definition of the partnership. But our objective or goal is to know how we usually tax the the partnership business. So these are the items that you need to consider when you are taxing the partnership business. So areas to consider, or items to consider: while taxing partnership business. Number one, determination of taxable income. Determination of taxable income, and say this is done using either or A, gross profit method, or number two, or B, net profit method. What we are saying is that when you are determining the taxable income of the partnership, just like other business, and as we introduced earlier on when you are introducing to the taxation of the business today, any business, when you are determining the taxable income, you either use the gross profit method or net profit method. So the same criteria apply to the taxation of the partnership. You either use the gross profit method or net profit method to get the taxable income. We have Roman 2. Another items that you need to consider when you are determining taxable income of the partnership or taxing the partnership is the following expenses: are not allowable in partnership. I.e., salary to the partner, to partners, interest on capital, interests on capital from partners to the partners, to the partners, commission and bonuses to partners, drawings by partners, and any private expense of the partners. That is the second thing that you need to know, that those expenses, when they are incurred by the partnership, they are considered to be non-allowable expenses. Salary to the partners, interest on capital, bonuses, the commission, the drawings. In short, we are saying any expense relating to the partner, like private expenses of the partner, we don't allow them when you're determining the taxable income. The third one that you need to consider, the following incomes: are non-taxable incomes in partnership, i.e., what are those incomes that are not taxable? Interest on drawings, profit on goods sold to partners, and any other income any other income from partners. That's another thing, that when you're determining the taxable income of the partnership, if there's any income that the partnership received from the partners, we treat it as non-taxable. This you'll hear like interest on drawings, like when the partner withdraw anything from the partnership, like goods, the cash, they are charged interest. That is an income to the partnership, but it is usually not taxable. Another thing is like sometimes they can have a provision, or the partners can have a provision that if a person want to buy goods from the business, can buy and they are going to be charged a profit like any other customer. So that profit is not taxable in the partnership, and any other income that the partnership may get from the partners. The fourth one is the income distribution schedule. Distribution schedule. What does that mean? Once taxable income of partnership is determined, it is distributed to partners using income distribution schedule where they bear individual tax burden. They are taxed individually at graduated scale rates in the same way as employment income. After the distribution. The gross tax once determined, then set-offs such as personal relief, insurance relief, and withholding tax on investment incomes are deducted. Income distribution schedule has the following format. So what we are saying is that about the income distribution schedule, once the taxable income of the partnership is determined, either using the gross profit or the net profit, we tax the income on the partners themselves, and we tax them at graduated scale rates. Graduated scale rates is the same as the employment income, the way we taxed the sole proprietorship, where once you distribute to the partners, because the partners are the one who bear the tax burden, you tax them individually. It is partner A, how much is the taxable income, tax individually at graduated scales. Partner B, how much is the taxable income, tax them individually. And then once you get the gross tax of each partner, you less the set-off. Set-off, we said that they reduce the actual tax they are supposed to pay, and they are like personal relief, the withholding tax on investment income, and insurance relief if they have life insurance cover, education insurance cover, or NHIF. Now, I want to show you how the distribution is done through the income distribution schedule or allocation schedule. So it has this format: income distribution, stock allocation schedule. We start by distributing the taxable operating income, and then we list the partners. Partner A, we are assuming partners are A, B, and then we have a column for the totals: shillings, shillings, shillings. So the taxable operating income you would have determined using either gross profit method or net profit method. You can distribute it this way. The first one is usually the salary. So salary to partners. If partners have the salaries, if this one had a salary, you put there this one and the total. The next one is interest on capital. Interests on capital. So interest on capital for this partner, for this one, and this, if there is any. Then commission or bonus. You put on this, this, and this. After that, those three are the one that you usually post. If there is commission or bonus, interest on capital, salaries to the partners. Then you less interest on drawings. Interest on drawings. So interest on drawings here, you less if anybody withdrew the goods and they were charged interest there. Now, after you have distributed those one, the taxable operating income you'd have determined, you minus what you have distributed, minus this, minus this, minus this, but this one you add. Then whatever remains you share according to the profit sharing ratio. We call it profit share. Shared according to profit sharing ratio. So you come, how much is this? This total. And then after that, get the total taxable operating income. Total taxable operating incomes means we take the salary, the interest on capital, if there is commission or bonus, less interest on drawings, profit share, you get the total here. You do the same for this, you do the same for that. Now, you have just distributed the operating income. Then you add taxable investment income. Taxable investment incomes shared according to profit sharing ratio. Sharing ratio. So if you have something like rent, non-qualifying dividend, non-qualifying interest, royalty, all those, remember, withholding tax is not final. You come and share here according to the profit sharing ratio. This one, total. And then now from there, you can get total taxable income. Total taxable incomes, which will take the operating income plus investment to get the total. Operating plus investment, operating plus investment there. And now, if you're asked about now taxing, getting the tax payable by partners, you will tax this one A individually on this using the graduated scales, the way we tax them sole proprietors income. The same case this one, a B, tax on this one to get the tax they are supposed to pay. So that is what you need to know when you are taxing the partnership business. And from there now, I want us to look at a question. So I read the question, then I'll show you how it is solved or computed. This is what the question says. And from there now, I want us to look at a question. So I read the question, then I'll show you how it is solved or computed. This is what the question says. Kamara, Susan, and Kubasu are a partnership, trading as Kasuku traders, sharing profits or losses equally. They have provided the following statement of profit or loss for the year ending that 1st December 2021. We have the gross profit, VAT refund, foreign exchange gain, dividend income net, a profit or disposal of furniture, rent income, then total income, then less expenses, insurance premiums, legal fee, depreciation, repair and maintenance, VAT paid, sundry expenses, interest on capital for Kamara, Susan, and Kubasu, motor vehicle expenses, custom duty, accountancy fee, bad and doubtful debts, rates and rent, salaries and wages, net loss. Additional information number 1. Insurance premiums include 282,500 paid to insure Susan's private car. Legal fee include parking fine, settling a dispute with a customer, appeal against tax assessment, court expense for breach of contract, preparation of tender documents. Number 3. Sundry expenses include interest charged on hire purchase, cash embezzled by cashier, registration of trademark. Number 4. Repair and maintenance comprised of the following: repair of furniture, installation of surveillance camera, cost of office furniture. Number 5. The partners took goods for personal use which had cost price of 225,000. The gross profit margin was 20% as recorded in the partnership books of account. The investment allowance were agreed with the Revenue Authority at 1475,000 during the year ending that 1st December 2021. Salaries and wages included salaries to the partners as follows: Kamara, Susan, Kubasu. So we are required to have the adjusted partnership profit or loss for that year and distribution schedule of the profit or loss computed in C1 above. So we prepare the income distribution schedule after getting the taxable income. So the first question is to get the taxable income of the partnership. Question is, which method are we supposed to use? Here we said if you are given net accounting profit, then you use the net profit method. Here we are given the net loss, which is a negative profit. That automatically means that you're supposed to use the net profit method. So we solve the question. We start with the name of the business, Kasuku Traders. Which is a partnership. We get the taxable income for the year ended that 1st December. (2021). As we had said, when you are given the net accounting profit or loss or income, we start with it and then we adjust it. So we'll start with net loss provided, which we are given in shillings, and we have 2956. 2956 75,000 negative or a loss. Then we add, we had said when you're using the net profit method, you add non-allowable expenses in P&L and taxable operating income not in P&L. Non-allowable expenses in P&L and taxable operating income not in P&L. What does that mean? We usually start with the first item, non-allowable expense in P&L, meaning in this P&L is the profit and loss account, which is the income statement. That in this income statement, as you can see, incomes were added and expenses deducted to get the net profit, which is a negative profit anyway. So we are saying of those expenses that were deducted, is there an expense that is not allowable? So that now it had been deducted to get the net profit. It's not allowable. It's not supposed to be deducted. We add it back. Before we go to the last one, I'll show you where we find it, because that one, as you can see, not in P&L. So we finish with this first one, as we had illustrated earlier on. Let us start with the expenses. We just follow the ones that are in the P&L. Insurance premium. Insurance is for the business, and it is usually allowable expenses. The other one is legal fee. Legal fee is also allowable, as long as they have not extended to what they entail. Depreciation, no. Depreciation is not allowable, as we have been saying, so we add it. It had been deducted, remember, and it is not allowable. 75,000. The other one is repair and maintenance. Repair and maintenance, that is allowable. It's for the business and it's allowable. VAT paid, we said any form of tax we don't allow. Any form of tax, VAT is a tax, value added tax, is not allowable. Had been deducted to get the net profit, and it's not supposed to be deducted, it's not allowable. We add it back. Next, sundry expenses. That those sundry expenses are small expenses put together for the business, and they are allowable. Interest on capital. We had even said it here that anything paid to the partners is not allowable. Partner salary, commission, interest, drawings, in private expense we don't allow. So that one had been deducted and it's not allowable. So interests on capital, which we have Kamara, we have Susan, Kubasu. So Kamara for 7,500. The other one is 185,000. The other one is 146,000. Then we continue motor vehicle expenses. Motor vehicle expense, those are expenses to run the motor vehicle. Don't say it's the cost of motor vehicle. When you hear motor vehicle, they are the expense to run motor vehicle, like fuel, repair. Those are allowable. But if they say the motor vehicle costs, that's now the cost of a motor vehicle. Fixed asset we don't allow. So this is allowable. Next is custom duty. Custom duty is a form of tax. We don't allow taxes. So we'll add it. Which we have 227,500. Next one is accountancy fee. Those are professional fee you pay. They are allowable because they are for the business. Bad and doubtful debt. Now when you hear doubtful debt, is a provision, a general provision, because you are doubting that they might not pay, they might pay. So it's just a provision. We don't allow provision unless it's specific provision for bad debt. The next one is rates and rent. Rates and rent, those are allowable expense because they are for the business. Salaries and wages, we also said those are allowable. They are for the business. They are revenue and commercial expenses. Now look, we are done with non-allowable expenses in P&L. Now we can look for taxable operating income not in P&L. What does that mean? It means that an income that is taxable but it has not been included in the P&L, in the income statement up here. So meaning it didn't increase the net profit that we have down there, although it's a loss, it's a negative profit. It didn't. So if it is not in the P&L, it did increase this net profit. Where do we find it? We can only find it in the additional information. So we go to the additional information to check for an income not in P&L. If it happen to be taxable operating, then we are going to add. However, when we go to the additional information, there's something else we normally check. You see, we say we are done with the expenses in the P&L, but you may go to the additional information and you are given analysis of those expenses that are in the P&L. Like the last expense we had salaries and wages in the P&L. You may go in the additional information and you're told that was to the partner. Remember, salary to the partner we don't allow. So we still come back and disallow it. So in the additional information, we not only look for taxable operating income not in P&L, but we also look for analysis of the expense in P&L. If they happen to be non-allowable, we still add them. Like if you go to the additional information number 1, we are told insurance premium incurred. Now insurance premium is an expense. When you go to the income statement, you'll find it is the first expense. So now we are told that one, it include 282,500 paid to insure Susan private car. Those we don't allow. Why? Because they are private expenses of Susan, who is a partner. We don't allow. So we disallow the 282,500. Insurance, Susan car, 282,500. Then number 2, legal fee incurred. Legal fee is an expense. Now, is it in the P&L? Yes. When you go to the P&L, the second expense, legal fee. Now, we need to determine if there's a component that is not allowable of that legal fee, so that we add it because it is in the P&L. It included parking fine. Parking fine, we don't allow them. Let me analyze them, then I post the one that are not allowable. Parking fine are non-allowable, so that will add setting a dispute with the customer, that is allowable. So if you remember what we said, legal expense related to customer is allowable expense. Then the other one is appeal against tax assessment. We said any expense relating to tax is not allowable. Relating any expense, any form of tax we don't allow. Expense relating to tax we don't allow. So this is not allowable. It's relating to tax. Court expenses for breach of contract. We said that. Legal expense relating to breach of contract we don't allow. The other one is preparation of tender document. Now that is allowable expense. So now let us disallow the ones that we have said. Parking fine, $150,000. Tax assessment, expense, which we have 62,500. We have breach of contract, costs or expense, 400,000. Preparation of tender that we said is allowed. After that, we go to number 3. Sundry expense incurred. Now, sundry expense is in the P&L. When you go to the P&L, you will find it there. So we need to determine the part that is not allowable. It included interest charged on hire purchase. We had said interest on money borrowed is allowable. Interest on money borrowed. So hire purchase is like you had taken an item through hire purchase, you had borrowed it, so you are paying the interest. That's allowable. Cash embezzled by cashier. We had said any expense that is not income generating, we don't allow. So it doesn't matter who embezzled. As long as it's an embezzlement, it is not income generating. We disallow. We will add it here. The other one is registration of trademark. We had said expenses relating to trademark, patent, copyright, we don't allow them. So these two, we disallow. Cash embezzled, by cashier, 565,000. The other one is registration of trademark, which we have 250. After that, we go to the point number 4. Repair and maintenance comprised of the following. So, repair and maintenance, if you go to the P&L, you'll find it. It is there, one of the expense. So, we check the part that is not allowable. We are told it included repair of furniture. Repair of furniture, those are normal business expense and it's allowable. Don't say it's relating to a fixed asset because it was incurred after the fixed asset had been purchased. It's already allowable. Installation of surveillance camera, that is the one that is not allowable because we had said when we were looking at the capital allowance, expense incurred before you start using a fixed asset. We normally claim capital allowance on them when we are claiming the capital allowance of that particular asset. So this one is not allowable because it's part of the cost of the fixed asset, the CCTV. Cost of office furniture, those are also not allowable because they are fixed asset. So we disallow the two. Installation of surveillance camera, where we have an amount of 812,500. The other one is the cost of office furniture. Costs of office furniture. Cost of office furniture, 525,000. Then we now go to number 5. The partners took goods for personal use which had a cost price of 225,000. The gross profit margin was 20% as recorded in the partnership books of account. So partners took goods, they were charged profit. It's like the goods were sold to them. Now, they were at the rate of 20%. Now, if you go to the income statement to check whether that profit is there, it is in the gross profit that you can see in the income statement. And what did we say about the income in the income statement? At the moment, we are interested with the income not in the P&L, not in the income statement. So if an income is in the income statement, we ignore for now. So we move on to the next one. Investment allowance were agreed with the Revenue Authority at 1475,000 during the year. Remember, investment allowance is equivalent to capital allowance. Capital allowance or investment allowance are allowable. Right now, we want the non-allowable expense in P&L. So that being allowable, we ignore. Number 7, salaries and wages include. If you go to the P&L, you'll find salaries and wages there. In that salaries and wages, we are told it included the one that were paid to the partner. We said anything paid to the partner, we usually don't allow it. So, salaries to the partner. Where we have Kamara, Susan, Kubasu, which we have 600,000. We have 450. And we have 225. And that is the end of the additional information, meaning we don't have any other item we are supposed to add because we are done with the expenses in P&L. Unfortunately, we didn't find taxable operating income not in P&L. Otherwise, it could have been in additional information. Now that we are done with the addition, remember we said now you come to the deduction. Deduction, we deduct 3 items. Less, non-taxable operating income in P&L. That is one. The second one is all investment income or investment incomes in P&L and allowable expenses not in P&L. So we are saying we first look for non-taxable operating incomes in P&L and all investment incomes in P&L before we look at the allowable not, because this one is not in P&L. We start with the first two. Now we go to the P&L and look for them, but unlike us, I like to delete this part here so that I can continue, and then once we are done, I can come and we distribute here. So the continuation is here. So let us go to the P&L, look for non-taxable income, meaning that in this income statement up here, there could be an income that is not taxable that was included. We remove because it increased the net profit there. We remove because it's not taxable. 2, if there is any investment income here, investment income increased the net profit, we remove it so that we remain with operating income only, as we had said. So we start with the first income, gross profit. Gross profit is a taxable income and does not have an issue because we are in the business of buying and selling the goods. So the profit we make is a taxable. But there was additional information number 5, that the partners took goods for personal use which had cost price of 225. The gross profit margin was 20% as recorded in the partnership books. We said any income to the partner is not from the partner is not taxable. So it's like the partners purchase the goods from the partnership because they are being charged the profit. We remove that profit. So profit on goods taken by partners. So here we are told the goods, the cost of the goods was 225,000. This is the cost. I want to remind you that whenever you are given margin and markup, I know you have done financial accounting or financial reporting. You are told whenever you are given the markup or margin and you want to get the profit, you must be very careful. That, remember, I want to illustrate here. Remember, markup, let me start with the margin. Margin is usually equivalent to profit over sales, which in this case we are told is 20%. So 20% stand for 20 over 100. Now we use the margin the way it is to get the profit if you are given the sale. Now in our question we are given the cost. The cost, we use the markup which is the profit over cost. So in this case then we have to ask yourselves, how much was the markup? You don't have to worry, you just need to use the margin to get the markup. How? See here we have profit over sales. Margin is profit over sales, which is 20 over 100. Profit, it is 20 then. Sales is 100 then. And here in the markup we have the profit. So bring this 20 here because it is the same. It's a common factor in the markup and margin. Profit, 20. And then now get the cost. Remember, even when we are doing the gross profit method, we were saying a sale minus the cost of sales, we get the profit. Now, if you want to get the cost, remember here we want to get the cost. If you want to get the cost of sales, then take this cost of sales together with the negative to the other side, and the profit will bring here. Remember, profit is positive here. When it come here, it will be negative. Cost is a negative here. When it go beyond the is equal sign, it become positive. So it's like saying the cost will be the sale minus the profit. So in this question, do we have the sale? Yes, the sales is here, which is 100. So we take 100 to get the cost minus the profit. Do we have the profit? Yes, the profit is 20. The one that we have even used here, minus 20, meaning it is 20 over 80. So now that we have the markup, and the markup is the one that you use the cost, now we can apply it directly. This is fraction 20 over 80 times 225 because that is the cost. So we'll come here and talk of times 100 over 80. And not 100 over 80, 20 over 80. 20 over 80. We do the computation so that we can get the profit that was charged on the partners. 225,000 times this 225, let me confirm, is 225. 225 times 20 divided by 80, which give us 56 to 50. So 56 to 50 we minus. Remember, we are minusing because it's an untaxable operating income in P&L. So I now continue here. Now we go back to the P&L, look for other non-taxable income and investment. After the gross profit, we have VAT refund. VAT refund is not even an income because you just overpaid your VAT and it's being refunded to you. So we remove VAT refund. VAT refund 102,500. It is a non-taxable income. It's not supposed to be taxed. The other one is foreign exchange gain. We only said the non-taxable foreign exchange gain is the unrealized one. Unrealized we should not tax. Actually, if we were told unrealized, we should have removed because it had been included to increase the net profit and it's not taxable. But when it is cited, what does that mean? It means it is realized. So if we say that it is realized, so that is taxable, we won't remove. Dividend income net. Dividend is an investment income, and we said all investment income in P&L or investment income in P&L, we remove them. So we remove dividend income. And somebody may ask, do we remove the net of the gross? My answer is, you remove the figure that increased the net profit. The figure there, whether net or gross, right now they are saying net 562.5. The 562.500 is the one that increased the net profit that we are adjusting. So remove it, whether gross or net. The figure is the key, 562,500. Then profit on disposal of furniture. If you remember, we said income from selling fixed assets we don't tax. So had been included in the in the income statement, they increased the net profit, it is not taxable. So profit on furniture. So profit on furniture, which we have 591,000. The other one is rental income. We said all investment income in P&L we remove. Rent is an investment, we remove rent income, which we have for 15,000. And that is the last income in the P&L. So we are done with non-taxable operating income in P&L and all the investment income in P&L. Now we look at the last part, allowable expense not in P&L. An expense that was supposed to be deducted in the P&L in the income statement to get this net profit, it had not been deducted, meaning this net profit, it is overstated. So we need to remove it. If it is not in the P&L, where do you find it? You find it in the additional information. Let us go to the additional information for an expense allowable not in P&L. Now we start with number 1, insurance premium. Now remember, we want expense not in P&L. Insurance premium is in the P&L. Leave it. Number 2, legal fee. Legal fee, if you go to the P&L in the income statement, you'll find it there. Leave it. Including, don't say, like in the legal fee, we are told it includes settling a dispute with the customer and also preparation of tender. Remember, those we said are allowable. Don't go to the P&L and you won't find them and say now they have not to be deducted. No, all of them are in the heading of the legal fee. So they are all inside the legal fee that is in the P&L. So as long as the heading is in the P&L, ignore it. So number 3, sundry expense is in the P&L. Repair and maintenance is in the P&L. Number 5 was about gross profit, not even an expense. Number 6, investment allowance were agreed with the revenue authority to be 1475,000 during the year. Now, investment allowance or capital allowance, it is allowable. It had not been deducted because if you go to the P&L, you will not find it having been deducted there. So we deduct. It is allowable expenses, not in P&L. Investment allowance written as that, in short, or CA for capital allowance for the year. For the year. For the year. For the year, which is how much? Here we are told it was agreed to be 1475,000. 1475,000. We continue getting the allowable not in P&L. Number 7, salaries and wages include. Salaries and wages is in the P&L, and there is no other expense that is not in P&L. However, I want to mention this. Sometimes you may not be given this investment allowance agreed. Like you may not be given that point number 6. Let's say it is not there. If you are not given, make sure you come back to the expenses that you disallowed. Check if you have a fixed asset. Remember, fixed asset we disallow so that we come and allow the capital allowance. You know, allowable expense not in the capital allowance. So if you are not given this, like in this case, we had which fixed asset? Here we had installation of CCTV. If you remember, we said capital allowance is at the rate of 10%. And then the next one is the installation of CCTV. There was office furniture, cost of office furniture here. Remember, office furniture, we are supposed to claim at the rate of 10% as well. So if you are not given this capital allowance, we could have come here and say capital allowance on installation of CCTV camera, 10% of the figure that we have, 812,500, we minus that figure. Then capital allowance on furniture, 10% of 525,000, we get the amount before. But if you are given the capital allowance, then you are okay. So with that one, then we are supposed to now get, since there is no other, we have considered every factor here, we can get the net taxable operating income. So taxable operating income, I want to do that first. So what we do, we start with this negative, we add all these figures, we minus these figures so that we can get the net. So I'll start. The first one is 2956 negative. Remember to minus negative. 2956,000 plus now positive 575,000 plus 233,750 plus 407,500 plus 185,000 plus 146,000 plus 227,500 plus 155,000 plus 282,500 plus 150,000 plus 62,500 62 did it first plus 62,500 plus 400,000 plus 565,000 plus 281,250 plus 812,500 plus 525,000 plus 600,000 plus 450,000 plus 225,000. Then now we start minusing 56,250. We minus 102,500 minus 562,500. We minus 591,000 minus 415,000. We minus 1475,000. So giving us 125,250. So we have 125,250. Now, having gotten the taxable operating income, having gotten the taxable operating this one, I want you to get the difference with the sole proprietorship and also the company. For the partnership, we don't add investment income here. Investment income, first we have to distribute this operating income among the partner until here we get the total taxable operating income. So the total we get here would be the same as this. And then the investment income we add here. So the investment income are not added here. They are added in the distribution schedule. So for now, this, we cross it that way for the partnership, because now we need to distribute. Now after that, we have answered required one. We were supposed to get the adjusted partnership profit or loss for the year. Here it is. Required two, distribution schedule for the profit or loss. We have answered required one. We were supposed to get the adjusted partnership profit or loss for the year. Here it is. Required two, distribution schedule for the profit or loss. So distribution schedule is the way we had said. So we'll come and now distribute whatever we have determined. So I'll delete just part of this. And then I'll also change the names here because they are two. And then I'll also change this. Let me delete this. So I'll call this the partnership name, Kasuku Traders Partnership. Income distribution or allocation schedule. And then here we noted there were three partners, by the way. So I'll delete this so that I can introduce the three partners. I'll give them the initials. As you have seen, there's Kamara. So I write KA to stand for Kamara, Susan, SU, and Kubasu, KU. And then totals, because of the space. So shillings, 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 shillings. So we had said the first thing we normally distribute is the salaries to the partner. So you just need to go to the question and determine if there was salaries to the partner. When you read through from the income statement, there was none. Additional information number 1, 2, 3. It was in point number 7. So you come and say now, salaries to the partner, Kamara, 600,000. Susan, 450. Kubasu, to 25,000. And now we get the total. We add the 3 to get the total. So 600,000 plus 450,000 plus 225, which give us total of 75,000. There. Then the second one is interest on capital. This one, when you go to the income statement, you have to remember the 4 that we talked about first. The salary, interest on capital, commission or bonus, there's interest on drawings, those 4. So you follow them that way. The next one is the interest on capital we had written. So we check. It is there in the income statement, interest on capital. So we'd have here 47,500. The other one is 185,000. The other one is 146,000. And now we get the total. So 407,500 plus 185 plus 146, which give us 738,500. Then the other one that we had here was the commission or bonus to partner. But I'm very sure as we went through the question, there were no commission or bonus to the partner. So if it is not there, ignore, just assume it. You go to the fourth one, raise interest on drawings. In the question, we didn't have interest on drawings to the partner, none. So now we do the last one, fifth one, which we said is the profit share. Profit share. So profit share, how do you get? We said we take the operating income, this one, of 125,250 minus what you have distributed. You have distributed this and this, which is 75,000 and also 738,500. Then what remains, you share according to the profit sharing ratio. That's what we said. Profit share, you share according to the profit sharing ratio. If you look at the first paragraph, is where we have the profit sharing ratio. Kamara, Susan, and Kubasu are in partnership trading as Kasuku, sharing profit and losses equally. They are three, each to get a third. So first one, a third. The other one, a third. The other one, a third. So let's see what remains. We'll start with 125,250, and then we minus 1275,000, and then we minus 738,500. Then we have negative. It will be negative. We have negative 1888. So I'll extend this a bit. 250, which is a negative. Now each is supposed to get a third, so you divide by 3. Each to get 629. 416. I want to round off to, because it's 416.6. 417. So 417, which is a negative. Same case here, because it's for each, and the other one is 629, 417. All there, remember, are negative. So from there now, we need to get the total taxable operating income. Operating income. So total taxable operating income would mean we take this plus this minus this, because it's a negative. The same case for everyone. So we start with 600 for the first one, 1,000 plus 407, 500 minus 629, 417, and then we get positive 3. So this would be 378, 083 positive. And then now we go to the second one for Susan, for 50,000, and then we add 185,000 minus 629, 417, 5583. Then for Kubasu, 225,000 plus 146,000 minus 629, 417. This is a loss of 258, so negative 258, 417. Then now we get the total, which would be 1275,000, and then we add 738, 500, and then we minus 1888, 250, which we get 125,250, 125,250. And that answer, you'll find it is starting with the operating income, because remember we have been distributing this operating income. Actually, we can even write it here. 125 to 50. So at the end, the total column should tally with the operating income because we have distributed through salary, interest, and profit share. Once you do that, now we said the investment income come here. You add the taxable investment income. Taxable investment incomes. So for the taxable investment incomes, so we need to go to the question, especially in the income statement, determine if we had an investment income, and then we share if it is taxable. The first investment income in the income statement is the dividend income, which we are told it is net. What we say is this: if you are given an income like dividend or interest, and you're not told where it's coming from, always assume it's a non-qualifying dividend or non-qualifying interest. Like this one, they have not indicated where it's coming from. So being non-qualifying means that the withholding tax was not final. We need to tax it further. So the dividend that we don't put here are the one that we indicated as exempt or qualifying, because exempt are not taxable. And here we are talking about taxable. Qualifying, withholding tax, it's final. You are not supposed to tax it again. So only non-qualifying. So this one, being that it has not been indicated, we assume it's non-qualifying, so it should be here. So dividend income, where we have 562,500, and then it is net. Remember, we said that for non-qualifying dividend, if you are told net, withholding tax is 15, meaning they have already deducted 15, meaning this is 85%. Remember, we said you only tax the gross. So if this 85, 100 will be what? To get 100, multiply by 100 over 85. And then profit sharing ratio, each was to get a third. A third. So it will be 562, 500. We multiply by 100, divide by 85, you get 661, 764. Uh, 765, we round off, and then divide by 3, which comes to 220, 588. Now with that one, we have distributed the dividend. There is another investment income, rent. We said if you're not told where the rent is coming from, you assume it's a commercial rent so that you tax it further. So here we have not been told. And then for the rent, you must minus the allowable expense relating to rent. Repair, caretaker salary for the rental. But for this question, we haven't been told whether there were any expenses relating to rent. So we distribute the way it is. So rent income, which we have 415,000, and then profit sharing ratio, each to get a third. So that would be in total 415 divide by 3, giving you 138,333. And then since there is no other investment income, we can now get total taxable incomes. So total taxable income, we do them this way. If the operating is positive, that's the time that we add investment. Like this one is positive. But if it is negative like this, we don't add. We cross it there. Remember, we said that a loss from one activity can only be deducted against profit of the same activity. So operating for this guy, this person, they had a negative. It will be carried forward to next year. So next year, when they generate a profit, he generate a profit or she generate a profit from the operating, she deduct this loss. So for this year, he will be taxed on the investment income only. So for this one who have positive are the one that we add. The negative we don't add, we only add the positives. So we start with the first one, 378,083. 083 plus 220, 588, 220, 588, and then we add 138, 333, which give us 737, 004. We go to the next one, 5583, and then we add to 20, 588, to 2588, and then we add 138, 333. We get 364, 504. For this one, remember we said we don't add the negative carry forward to next year, we only add the positives. So 220, 588 plus 138, 333, which we get 358, 921. And then we go to the total, 125 to 50 plus 661, 765, and then we add 415,000, so giving us 1202, 015. Yeah. And the question ends there, and this total cannot be the same as this way because this we didn't add, so this we carry forward to next year. So as per the question, that is where we stop, and that is how we determine the taxable income of the partnership, and we do the distribution. For now, we are going to stop there until I see you in our next lesson, where we are remaining with one business, that is the limited company. We see how limited companies are usually taxed. Thank you very much. However, make sure that you do the assignment that is being shown at the end of this video. Thank you very much. Hi there, my name is Patrick Kamau. You are a lecturer in public finance and taxation. Welcome to today's lesson. Today we continue from where we stopped last time. Remember, the topic we are looking at the moment is called the taxation of the business income. And we said that there are three businesses that we need to look at how they are usually taxed: the sole proprietorship, partnership, and the limited company. So far, we have looked at the sole proprietorship. Last lesson, we started looking at the partnership, whereby after looking at how partnership is usually taxed, we went ahead and we used the net profit method to get the taxable income of the partnership. So today we continue with the same lesson, but we look at another question where we used a different approach to answer the same question, a different question using now the gross profit method. Welcome to today's lesson. So we are going to start by reading the question. After reading the question, then I'm going to help you solve the question. So here is the question. This is what the question says. Karimu and Shika commenced trading in partnership as Kashi on January 2019. They share profits and losses in the ratio of 2:1 for Karimu Shika respectively. The partners were to receive monthly salaries of 18,000 and 22,000 for Karimu Shika respectively. The partnership did not maintain complete set of accounting records. The following summary of the bank statement for that year has been presented to you. So we have the receipts consisting of capital introduced, Karimu and Shika, cash sales, receipts from debtors, sale of a van. We go to the payment side. equipment of office, rent for go down, salaries and wages, purchase of for resale, repair and maintenance, insurance, interest expense, motor vehicle expenses, sundry expenses, motor van purchased, tax penalty, electricity, medical expenses, balance carried forward. Additional information, number one, the following payments were made in cash from the cash sales before banking. We have the motor vehicle expenses per annum, wages per annum, sundry expenses per annum, weekly drawings for Karimu and Shika. During the year, discount received from the supplier amounted to 132,500, while the discount allowed to customers amounted to 118,000. As at that 1st December 2019, electricity and insurance prepaid were 25,000 and 12,800 respectively. Depreciation was to be provided on equipment at 10% on a straight line basis. As at that 1st December 2019, the amount owed to supplier was 780, while the amount owed by the customer amounted to 1420. An amount of it 2,000 owed by Jamila Mamba, a customer, proved irrecoverable and is to be written off as bad debt. This amount was excluded from the total amount owed by a customer as at that 1st December 2019. Salaries and wages include the salaries to the partners. The go down had been occupied since 1st November 2019 at an annual rent of 450,000. Included in the interest expense is the interest on partners' capital contribution at the rate of 5% per annum. The wear and tear allowance, and it's good to note that wear and tear allowance is the same as the capital allowance. So wear and tear capital allowance was agreed with the Revenue Authority to be 112,000 for the year ended at 1st December 2019. So number 11, closing inventory was valued at 620,000 on 31st December 2019. Assume that year of income had 52 weeks. Required, 1, adjusted partnership profit or loss for the year 2019, and number 2, distribution schedule of the profit or loss calculated in C1 above. So the first question is to get the taxable income, and we say that whenever you are told to get the taxable income of any business, you either use the gross profit approach or the net profit approach. Net profit approach, we said, is when you have been given net accounting profit or loss or income somewhere. If you haven't been given, you use the gross profit method. So this question, we are not given the net profit or loss or income. So automatically we use the gross profit method. Now gross profit method, we said, we usually start with the sales. We less the cost of sales. Cost of sales, we take the opening stock plus purchases, less closing stock minus any item that reduce the stock. And then we get the cost of sales. We less from the sales, we get gross profit. And the reason why we call it gross profit, we said. And then you add other taxable operating income, and then you less the allowable expenses. So, but we said before you start, always confirm, do you have the sales? Do you have the total purchases? If you don't have, or you haven't been given, then in that case you have to determine them first. So in this question, we take note that we're starting with the sales, we are given only one, the cash sales. But the cash sales does not represent the total sales. We have to look for the credit sales. We add to the cash, we get the total. So now, we are not given the sales, so we have to look for it. The other one is the purchases. Have we been given the purchases? Yes. In the payment, in the statement of bank statement, there is a purchase for resale, but that is a cash purchase. Now, how about the credit? So in this case, we have to determine the credit purchase so that we can add to that cash, we get the total purchases. So this is what we said you normally do. To get the total sales, you do it this way. You say total sales is equals to credit sales plus cash sales. We said for the cash sales you'll be given, it is there, like we have seen, it's already there. The issue is about the credit sales, where you have to determine it. Now, the best way to approach the question, we said, leave a space like 2 lines, where now you'll be able to open the debtors or receivable account to determine the credit sales. So we'll come here and have the debtors stock receivable. You start with balance brought down here. That's what we said for the debtors. And then jump 4 or 5 lines here where you'll be posting those items that affect the debtors. And then balance at the end here for the debtors. And then totals will be here. Same case on the purchases. We say total purchases is as a result of credit purchase plus cash purchases. For the credit purchase, we jump a space of 2 or 1 line, and then we have the creditors or payables account, where we will be able to get the credit purchase. Then for the creditors, you start with balance pro down here for the creditors, and then jump 4 or 5 lines, then have the balance carry down for the same creditors. And then you'll be able to post everything and the totals there. Once you have done that, now go through the whole question. If you come across some cash sales here, something affecting the debtors here, cash purchase here, anything affecting the creditors here. So we start. From the first paragraph, the only figures that we have are 18,022, which were monthly salaries to the partners. So those do not affect, so we ignore. We go to the receipt. Capital, introduced, that's not. Cash sales, yes, here. So we post it here, 700,000. And then receipts from debtors. Receipts from debtors, we said it reduces the debtors. Here, receipts, which we have 5,200,000. Then sale of motor van, that doesn't affect. We go to the payment side. Equipment for the office, that does not affect. Rent for the go down doesn't. Salaries and wages, no. Purchase for resale, yes. Here, that's a cash purchase, of which case we have 9,900,000. The other one is the repair and maintenance doesn't affect. Insurance, interest, motor vehicle, sundry expense. Motor vehicle purchase, that's a fixed asset, not goods. Remember, what we are looking for are for the goods. Tax penalties, electricity, medical expense, balance carried forward, those do not. Then we go to the additional information number 1. The following payments were made in cash from cash sales before banking, meaning what went to the bank, as we can see the bank statement was this. But before that figure was posted, not really this one, but the one in the bank statement, we had 12,700, this one. But before they banked the 12,700, they had paid some expenses, meaning our cash sales was more than what was banked. So to get the how much it was, we need to add the one that was sold on the one that was sold on cash and then used to pay the expenses. Which one? Motor vehicle expense. So the key thing there was from cash sales, were paid from the cash sales. Motor vehicle expense per annum, that we had 138,000. The other one is wages, 162, plus sundry expenses per annum, 35. Then weekly drawings by Karimu and Shika. So weekly drawings for the whole year, it has to be for the 52 weeks. So 52 weeks times, now weekly for the total, which is 7,200 plus 6,400. And that ends there. From there we go to number 2. During the year, discount received from the supplier amounted to 132,500. Discount received reduces the creditors, so we'll have it here. Discount received, which we had 132,500. The other one, while discount allowed to customers amounted to 118,000. Discount allowed, which reduces the debtors, discount allowed, which we have 118,000. I want to bring this one a little bit up here, but I haven't changed anything. It's just this. And so we had said the balance carried down for the creditors. We leave it there. So we continue. After that, we go to the point number 3. As at 31st December 2019, electricity and insurance prepaid were 25,000 and 12,800 respectively. That doesn't affect. Depreciation was to be provided on equipment at 10% straight line. No. As at 31st December 2019, the amount owed to supplier was 780. Now, this at the end of the year, what the supplier are owing is 780,000. And then, while the amount owed by customer 1420, what is owed by the customer is 1420 at the end there. We continue. An amount of 82,000 owed by Jamira Mamba, a customer, proved irrecoverable and is to be written off as bad. This amount was excluded in the total amount owed by the customer as at 31st December 2019. So that's a bad debt written off. Bad debt written off reduces the debtors written off, which we have 82,000. 82,000. The other one is number 7. Salaries and wages include salaries to the partners. That doesn't affect. Number 8, go down had been occupied since 1st November 2019 at an annual rent of that. Doesn't affect. Included in the interest expense is the interest on partners' capital contribution at the rate of 5% per annum. Doesn't affect. The wear and tear allowance was agreed with the Revenue Authority to be 112,000 for the year 2019. Doesn't affect. Closing inventory was valued at 620 on that 1st December 2019. Doesn't affect. So we are done. So from there we do the computation. So we are going to add the totals on this side and compare to the total on this side. Actually, we have seen the balance brew down is 0 and also balance brew down here because we started or they started the business at the beginning of the current year. So there was no balances from last year. So it's all about the total on this side would be now the credit sales here. Credit sales. So we add them 5,200 thousand plus 118,000 plus 82,000 plus 1420, which gives us 6820,000. And this one 6820 should be the totals 6820 because we now have written the balancing figure. So then this one we transfer it here 6820,000, which we should be able to add now the cash. So we'll start by taking 7,200 plus 6,400 times 52. So it will be 7,200 plus 6,400 times 52 weeks because that was per week. That becomes 707,200 plus 35,000 plus 162,000 plus 138,000 plus 12,700,000. Then now we add this one plus 6820,000. 6820,000 giving us 20,562,200. That is the total. We come here, we add this plus this. This is 0, so that will be the credit purchases. So this plus this 132,500 plus 780,000. So that will be 912,500, which will be here 912,500. 912,500. We transfer that one here 912,500, and then now we add the cash purchase. So plus 9,900, which give us 10,812,500 there. With that one now, we can prepare the statement of determining the taxable income. So we'll come here, the name of the partnership is Kashi Enterprise Partnership. We get the taxable income for the year ended 31st of December 2019. So we start with the sales, which we had determined 20, 562,500. Then we less cost of sales. Cost of sales, which we take the opening stock. But here you'll note that we were not given the opening stock because we started the business at the start of this year. So there were no opening stock from last year. So 0 plus the purchases. Purchases is what we have determined here. 10, 8, 12, 500. Then we minus the closing stock. Closing stock is the one given in point number 11, 620,000. So minus 620,000. And then we also minus any item that could have reduced the stock during the year. Damaged, withdrawn stock, stolen, of which case the whole of this question, we didn't have any stock that was stolen, damaged, or withdrawn by the partners. There was none. Let me confirm properly. There wasn't any. The drawings that we are given in additional information, number 1 was cash drawings, not goods. So in this case, we cross to get the cost of sales. Cost of sales, which will be the 10, 8, 12, 500, you minus 620,000. And that gives us 10, 192, 500. And then we can be able to get the gross profit. Gross profit will be, we minus that from 20, 562, 500. And that gives us 10, 370,000. Then we said this, after getting gross profit, and the reason why we call it gross profit method is to add other taxable operating income. Other taxable operating incomes. Other taxable operating incomes. Of which case we said you jump a space of like 3 lines and then you less. I want to bring this one here, 1,000. So you less allowable expense after jumping around 3 lines. Allowable expenses. So what we do now, we go through the whole question. If we come across a taxable operating income, an allowable expense, we post here. We start from the top. The first paragraph was about the salaries to the partner. We said anything to the partner we don't allow. It's an expense yet, but not allowable, so we cannot post. We go to the summary of the bank statement. On the receipt side, capital is not an income or an expense. Cash sales, we used it to get the sales. Receipts from debtors, we use it to get the sales. Sales from the van, we said income from selling fixed assets, we don't tax, so we cannot post here. We go to the payment. Equipment. Equipment is a fixed asset, which we should claim capital allowance at the rate of 10%. But we won't do that. Why? If you look at additional information number 10, We are told the wear and tear allowance, which we said is the same as capital allowance, was agreed with the revenue authority to be 112,000. So that's the one that we use. Anywhere we require to compute capital allowance, we use that. So we can even post it now. The capital allowance, also called WTA or wear and tear allowance for the year. It was agreed to be 112,000. From there, we go back to where we found that in the bank statement. After equipment, rent for go down. That's an allowable expense, rent expense. But we have an additional information to that rent. If something has an additional information, check it out. In additional information number 8, the go down has been occupied since 1st November 2019 at an annual rent of 450. So annual is per year. And now it was occupied from 1st November. Those are 2 months. So forget about the one that you are given. Use the one that you can get for this particular year. So in this case, we are going to take 2/12 times the 450 because it was only occupied for 2 months to the end of the year in this particular year. So this is going to be 2/12 times 450. That will be 75,000. That is the one that we allow. Any other, we forget. Then we go back. After the rent for the go down, salaries and wages. That is allowable. But we have to check whether it is mentioned somewhere else. Salaries and wages. Yes, it had been mentioned in additional information number 7. The salaries and wages include the salaries paid to the partners. Salaries. And here they have made it very clear that it is salaries and wages. Another place that we have wages now mentioned is number 1. The following payment made through the cash from the banking. So we have the wages. So what do? We'll come here and have the salaries and wages. So we open a bracket. Remember, we want to know the allowable salaries and wages for this year. 890,000. And then now we have to add the one that was paid through the cash. This was through the bank. The cash was 162. And then number 7, it includes the one paid to the partners. So we have to remove because we said anything to the partners we don't allow. To the partners was how much? In the first paragraph is where we were told the monthly salaries to the partner was 18 and 22,000. Monthly, underline monthly. So meaning to get to the whole year, we have to take minus 12 times 18,000 plus 22,000. So that we can get, and since it is not mentioned somewhere else, we do the computation. So we take first of all the 18,000 plus 22,000, and then you multiply by 12 months because it was monthly. We get for 80,000. Then we remove them from this. So we take 890 plus 162 minus 480. That gives us 572. That's the one that we should be arriving there. After that, we go back to where we found the salaries and wages. After salaries and wages in the bank statement, purchases for resale, that we use to get the purchases up there. Repair and maintenance, that is another allowable expense. Repair and maintenance. So we check if it is mentioned somewhere else. There isn't. So we just pick the figure as it is, 860,000. After that, we go back. After the repair and maintenance, there is insurance. Insurance is also a allowable expense. So we have insurance. Is it mentioned somewhere else? Yes. Additional information number 3. As at 31st December 2019, electricity and insurance prepaid. So this was prepaid, and it's at the end of the year. We said prepaid at the end of the year is for next year, not for this. Anything that is not for this year, we minus. So we are going to take the insurance of 62.5, and then we minus the prepayment, which we have 12,800. That will give us how much? This will be 62. 500, we minus 12,800. That gives us 49,700. After that, we go back to where we found the insurance. After the insurance, there is interest expense. Interest, we said, is allowable. So interest expense. But it is mentioned somewhere else. In additional information number 9, included in the interest expense is the interest on partner's capital contribution at the rate of 5%. Included in interest. Anything to the partner we don't allow. So we will take this interest, which is 612,000, and then we minus the one that was paid to the partners, which was 5% of the capital. The capital is in the bank statement, where we have for the two partners 3,500 plus we have the 2,500, that is 2,500,000. That. So we add the capitals, which are 35 plus 25 times 5%, which give us 300,000, and we minus from 612, that give us 312,000. That's the one that is allowable, the one paid to the partners. Then we go back after the salary, after the interest, after the interest. Motor vehicle expense. Motor vehicle expense is allowable. And we say that is not the cost of motor vehicle. It's the vehicle, expense incurred to run the motor vehicle. Fuel, repair. So in this case, that is allowable, not a fixed asset. Motor vehicle expenses. Where we are told the motor vehicle expense is 186,500. After that, we have sundry expense. Maybe there is something that I should have confirmed. In additional information number 1, there is more motor vehicle expense. The one that was paid in cash, 138. We forgot about that, so we should add it. So it will be 186,500 plus the one that was paid cash, which we have 138,000. 138,000. We check if it is mentioned somewhere else, but the motor vehicle is not mentioned anywhere else. So what does that mean? Then that means that we do the computation. 186,500 plus 138,000, which we get that 245,000. That 245,100. Then we go back after the motor vehicle expense. We have sundry expense. Sundry expense is an allowable expense, so we continue. Sundry expenses. And this one again, it is mentioned somewhere else in additional information number 1, the one that was paid through the cash. So we'll have 218,000, and then we add the one that was paid through cash, which we have 35,000, which we have 218 plus 35,000, which give us 253,000. Then we go back after the sundry expenses. Motor van purchased. That's a fixed asset which we should claim capital allowance. But remember, we were already given the capital allowance, so we ignore. Tax penalties. We said any expense relating to tax we don't allow. Electricity expense, that is allowable. So electricity expense. But we check for the additional information. If you go to the additional information number 3, we had electricity prepaid, and we said prepaid is for next year. So that one we need to remove. We need to minus, because of what was paid this year of the electricity, 45,800. Part of it is for next year, and so we should minus from here, where we have the 25,000. That gives us 2,800. Then we go back to where we found that. After the electricity, there is medical expense. Medical expense are allowable unless we are told it was relating to the partner, which we haven't been told. So medical expense. Medical expenses 630,000. Then now we go to the additional information for any taxable, operating, or allowable expense. Additional information number 1, the following payments were made in cash from cash sales. Motor vehicle expense we have considered, wages we have, sundry expense we did, weekly drawings, those are not allowable expenses. Additional information number 2, those are the figures for the balances of debtors and creditors at the end of the year. So they are not incomes or expenses. Number 3, we have already adjusted for them. Number 4, depreciation. Remember we said depreciation is not allowable. We claim capital allowance instead, which we have been given. Then number 5, as at 31st December 2019, the amount owed to supplier was 780, while the amount owed by customer was 1420,000. That we had said actually, there's something, there's additional information we jumped. We jumped number 2, during the year, discount received from the supplier amounted to 132,500, while the discount allowed to customers amounted to 118. Discount received, that we know is a taxable operating income, so it should come here. Discount received, that is a taxable operating income. And we have the discount received of 132,500. And then we have the discount allowed. Discount allowed is an expense and it's allowable. Discount allowed. Discount allowed, which we have been given as 118,000. There. From there we continue. We were actually in point number 5. That's where we were saying that we had the balances at the beginning and also at the end. And then from there, number 6. An amount of 82,000 owed by Jamila Mamba, a customer proved irrecoverable, and it is to be written off as bad debt. This amount was excluded in the total amount owed by the customer as at 31st December 2019. That is a bad debt written off, which we said is allowable expense. So we'll have bad debt written off. Bad debt written off, which we have an amount of 82,000. After that, we go to number 7 now. Salaries and wages include the salaries paid to the partner. Now that we had adjusted in the salary here, if we had forgotten, now you should be able to adjust. Number 8, we had adjusted on the rent. Number 9, we had adjusted in the interest. Number 10, capital allowance we had posted. Closing inventory that we used to get the cost of sales here. There is nowhere else it's supposed to be used. Now that is the end. What remains, and this being a partnership, it should end here, is to get the net taxable operating income. So how do you get the net taxable operating income? It is the gross profit plus discount received minus these expenses. So we do the computation. So we start with the 10, 370,000 plus 132,500 minus 112,000 minus 75,000 minus 572,000 minus 860 minus 49,700. Remember this was 7. 49,700 minus 312 minus 324.5 minus 253 minus 2,800 minus 630 minus 118 minus 82,000. That gives us 7,093,500. And that answers required 1, where we are supposed to get the taxable profit of the partnership. With that one, we are supposed to go to the required number 2, where we do the income distribution. So the income distribution schedule, this is what we said or how it is supposed to look like. So income distribution schedule. We start by distributing the operating income. So we will start with taxable operating incomes, which is the one that we have determined here, 70, 93, 500. And then now we list the partners that we have, which we have Karimu, Shika, and now the totals. So we go through the question. Remember, we start by looking for the first 4 items that we said: the salary, interest on capital, commission or bonus, less interest on drawings. Those 4. So if you look at the first paragraph, we had the salary to the partner, salary, which we were told it was per month. So the first one was to get 18,000 times 12. The other one was to get 22,000 times 12. Because they were monthly amounts. So we have 18 times 12, which give us 216,000. So 216,000. The other one is 22,000 times 12, giving us 264,000. And now we have the total plus 216. 480 for 80,000. Then we go to the capital, to the cash bank statement. In the bank statement on the receipt, we had capital, which is not one of the item we are posting. You go to the payment side, there is none. You go to the additional information, number 1, drawings we said we ignore. Number 2, no. 3, no. 4, no. 5, no. 6, no. 7, we have posted. 8, no. 9, there is also the other one is 25 for each. So we start with 5% of 35, which gives us 175,000. The other one is 25 times 5%, giving us 125,000, and the total gives us 300,000. Then after that, point number 10, none, and 11, there is none. So the only remaining one is now the 5th one, profit share. How do you get the profit share? We said you take the taxable operating income we have, like in this case we have 70, 93, 500, and then you minus what has been shared already. We have shared the 480,000 and also shared the 300,000. So whatever remains you share according to the profit sharing ratio. And what was the profit sharing ratio? In the first paragraph, they were sharing 2 to 1. So the first one will get 2 out of 3, the other one 1 out of 3. So let's minus 70, 93, 500, we minus 480, and also we minus 300,000. 480,000 and 300,000 give us 6313. So 6313, 500. Then the first one will get 2 over 3. That give us 4209. 4209,900. 1,000, sorry. And then the other one, we can take the 6313,500 minus what we have given this. 63 13 500. That will give us 21,04,500. And now we can get the total taxable operating income. Total taxable operating income. So for Karimu, it will be 216,000. We add 175,000. We add 4209, which we get 4,600,000. The other one will be 264,000. We add 125,000, and then we add 2104, 500, which gives us 2493, 500. And now the total, which would be 480,000 plus 300, and then we add 63, 13,500, which give us 1793, 500, and which is the same as the operating income we had determined. Remember, if we had an investment income that is taxable for this question, after getting the operating income, we add taxable investment income, and we share and then get total. But the whole of this question didn't have an investment income. So meaning our question then should end here. So this one will give us now the total taxable income, which should end there. That is how we tax a partnership when you have not been given the net accounting profit. So for this question ends here. And now what is remaining is the taxation of the limited company, which we are going to look at in our next lesson. For now, we stop there until we meet in the next lesson. After this video, there is some assignments, questions that you can attempt. Kindly do attempt and then see if you can be able to do the way we have done it. Thank you very much.
The tender box, then we move to the opening of tenders. What are the processes, the procedure in opening? Number 5, opening of tenders. Are you following the process? We are now at the stage called opening of tenders. Opening of tenders. Tenders are now in envelopes. The tenders are in the envelopes, then they are placed in the box. How are the tenders to be opened? Now, candidates and accounting officer of a procuring entity should appoint a tender opening committee. Should do what? Should appoint a tender opening committee. That's a very important step. Number 1, appoint a tender opening committee. Should appoint a tender opening committee, specifically for the procurement in accordance with the requirements. All right? And this committee, candidates, shall comprise at least 3 members. At least 3 members. That means the committee should not have 2 or 1 member. Should be at least 3. Either 3 or 4 or 5, more than 3. That is tender opening committee. Tender opening committee. And at least one of the members should not be directly involved in the processing.
Do you understand? Out of the 3 members, there ought to be at least one member who should not be directly involved in processing or evaluation of the tenders. So step number 1, appoint a tender opening committee. Now this committee should comprise of at least 3 members, and then at least one of the members should not be directly involved in the process of in the processing or evaluation of tenders. At least one of the members, at least one. Then the second important point in opening of tenders is that any bid withdrawn in writing should not be eligible for evaluation. Any bid withdrawn in writing. If out of the tenders that have been submitted, a tenderer opts to withdraw the tender. So that tender then, that withdrawal should be in writing. And if a tenderer has withdrawn in writing, then such tender should not be eligible for evaluation. Withdrawal must be in writing. And if it is in writing, then it's not eligible for evaluation. Any bid withdrawn in writing shall not be eligible for evaluation or consideration in the tender process. Number 3, open all tenders before deadline. That's an important step, opening of the tenders. Remember, we are discussing opening of the tenders. Before the tenders are opened, first of all, put in place a tender opening committee. This committee should have at least 3 members, and at least 1 member should not be involved in the process of evaluating the tenders. Then if there is anyone who has withdrawn, who submitted the tenders but decides to withdraw, that withdrawal must be in writing. And if it's not in writing, then the tender is still eligible for evaluation. Number 3, open all tenders before deadline. Open all tenders before deadline. Immediately after the deadline for submission tenders, immediately after. Because we say that all tenders, earlier on we have said in invitation that all tenders must be delivered before the date, before the deadline date. So if they are delivered before the deadline date, then it's a requirement that all the tenders that have been received before the deadline date, then they should be also opened before the deadline date. So immediately after the deadline for submission tenders, after the deadline of submission of tenders, which is before the deadline, all right, the tender opening committee should open all tenders received before the deadline. Open all tenders received before the deadline. Four is attending. There is a guideline on attending the opening of tenders by the tenderers. Those submitting tenders or their representatives may attend the opening of tenders. Those submitting tenders may attend. Let me just write it. Those submitting tenders may attend the opening of tenders, or they may send their representatives. This is just to be transparent. openness, which is an important principle in the Constitution. Transparency, openness. So when opening the tenders, then those who submitted the tenders are free to attend. They are also free to send their representatives to attend the opening of the tenders. Number five is identification number. That's a point on identification number. The tender opening committee shall assign an identification number to each tender and record the number of pages received. Do you understand? An identification number is assigned each tender opened, an identification number. Then there is also registration of the number of pages received. There should be a record of the number of pages received. 6, reading out aloud. When opening the tender, there are certain things that must be read out aloud, because you see, this is a public exercise. As each tender is received, there are things that must be read out and recorded in a document to be called the tender opening register, and recorded in a tender opening register. As each tender is opened, because note that the tenders were received and placed in a tender box. A committee has been formed to open the tenders. A committee of 3, not less than 3, and when they are received, they are assigned identification numbers. Each tender is assigned identification number, and the pages are to be recorded, the number of pages received. Number 6, while opening the tenders, there are certain things that are read out and recorded in a document which is known as a tender opening register. So what are these things that are read out? Number 1 is the name of the person submitting the tender. Number 2 to be read out is the total price, where applicable, including any modifications or discounts received before the deadline for submission of tenders, except as may be prescribed. Also to be read out is what has been given as a tender security. So in this register, we need to have those items. If there is any tender security, then it has to be read out and recorded. The name of the person submitting the tender has to be read out and recorded in the tender opening register. The security also, and the total price. Do you understand? Then number 7 is a point on disqualification. No tenderer shall be disqualified by the procuring entity during opening of tenders. No tenderer should be disqualified during tender opening process. It is not the work of the tender opening committee to qualify or to disqualify the tenderers. No tenderer should be disqualified during the tender opening process. No tenderer shall be disqualified during opening of tenders. Then number 8, we can say that the accounting officer of a procuring entity shall, on request, provide a copy of the tender opening register. Provide copy of tender opening register upon request. If any of the tenderers or representatives of the tenderers would want to have a copy of the register, tender opening register, then the accounting officer should do so. A copy of the tender opening register to a person submitting a tender. So if there's a person submitting a tender who would want to have a copy of the tender opening register, then the accounting officer of the procuring entity will do so, will provide the tender opening register. Tender opening register on request. Number 9, signing. Signing. We've seen how the process goes. Until now, we have the tenders have been opened, the information, a register has been opened, copies on request have been given to those submitting tenders. Then there is a signing. Each member of the tender committee, we said there are at least 3 members. If there are 3 or 4 or 5, each member of the tender opening committee is required to sign each tender on 1 or more pages as determined by the tender opening committee. So if the tender has, say, 20 pages, the committee can decide either the members sign all the pages or number of pages as they determine. That is signing on the pages of the tender. Then number 2, the members of the tender opening committee are also required to initial in each tender against the quotation of the price and any modifications or discounts where applicable. They also need to initial, to sign and initial. Let me write initial. They are required to sign and also initial in each tender against the quotation of the price. That is number 9. Number 10, there is an important procedure known as minutes. Minutes. The tender opening committee shall prepare tender opening minutes, which shall set out certain things. Number 1 being the record of the procedure followed in opening the tenders. Number 2, within the minutes, they need to include the particulars of those persons submitting tenders or their representatives. They need to minute who attended the opening of the tenders and so on. So there ought to be minutes, because this is a committee that has been mandated to carry out a process. So the committee is required by law to prepare what is known as tender opening minutes. And in the minutes, there ought to be procedures that they followed. What procedures did they follow in opening the tenders? That is an important aspect. And the particulars. Particulars of those who submitted the tenders and those who attended, attendees. Then number 11, the tender opening committee should acknowledge that the minutes are a true reflection of the proceedings held. And how will that acknowledgement be done? Number one is by initialing each page of the minute. Then they are also required to append their signature as well as initialing the final page of minutes indicating their full name and designation. Do you understand? I'm saying that the last procedure to be carried out by the tender opening committee is to acknowledge that the minutes are a true reflection of the proceedings, because here they are supposed to draft minutes. But they need to also acknowledge that the minutes that they have drafted are a true reflection of the proceedings held. And each member of the tender opening committee is required to initial each page of the minutes. Initial each page of the minutes. They are required to initial each page of the minutes, then append their signatures. Append signatures. They append what? They append their signatures as well as designation. Here they initialed the minutes. They again initial they initial the documents. Here they are initialing the minutes. So that is opening of tenders. And it should be noted that any person, a person who causes physical loss of tender documents, the tender documents that have been provided, a person who causes physical loss commits an offense. A person who does what? Who causes physical loss, who causes physical loss of tender documents. The tender documents provided commits an offense. So these are the procedures in the opening of tenders. 1. Appoint a tender opening committee. 2. Any bid withdrawn in writing should not be eligible for evaluation. 3. Open all tenders before deadline. 4. Those submitting tenders may attend the opening of tenders. 5. This is 1, 2, 3, 4, 5. Identification number is assigned each tender. 6. Reading out aloud and recording certain things in a tender opening register. We saw what should be read out, like the names of those who submitted tenders and so on. Then no tenderer should be disqualified during the opening of tenders. Number 8, provide a copy of a tender opening register. A copy of opening register should be provided to those who require or request. Number 9 is signing and initialing of tender documents. Number 10, minuting the procedures, particulars, and attendees minutes. Then initial each page of the minutes, append signatures and append signatures. 12, a person who causes physical loss of tender documents provided commits an offense. So that is the opening of tenders stage. Then we move to the responsiveness of tenders. 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 Now, Candidates Section 79 of the Public Procurement and Asset Disposal Act provides that a tender is responsive if it conforms to the eligibility and other mandatory requirements in the tender documents. Do you understand what we mean by responsiveness of tenders? The law says that a tender is responsive if it conforms to all the eligibility, if it conforms to all the eligibility and requirements of the tender documents. You remember we mentioned tender documents before beginning the process. We have standard tender documents. And I took time to explain what these documents are, what they are contained, who develops the documents, and so on. So, responsiveness of tender refers to or means conforming to, or it means conforming to all the eligibility and requirements of tender documents and other mandatory requirements in tender documents. And a responsive tender cannot be affected, by minor deviations, because as much as I was saying that the tenderers must ensure that they've submitted all the requirements, the mandatory requirements, and what are the eligibility requirements of the tender documents. A responsive tender cannot be affected by minor deviations that do not materially depart from the requirements set out in the tender documents, or even errors. A responsive tender cannot be affected by errors, it cannot be affected by oversights, cannot be affected by errors, cannot be affected by oversights that can be corrected without affecting the substance of the tender. So as much as we desire to follow the letter of the law, these processes are carried out by human beings who are prone to error, who are prone to mistakes, are prone to oversights, and therefore a responsive tender cannot be affected by minor deviations. Minor what? Deviations that do not materially depart from the requirements set out in the tender documents, or even errors or oversights that can be corrected without affecting the substance of the tender. So that is what we mean by responsiveness of the tender. So you can see the process. After the tenders are opened, then we check for responsiveness of the tenders. Does the tender conform to the eligibility and other requirements? That is the next stage. Responsiveness of tender. Do the tender the tenders that have been received meet the mandatory requirements of the law. And as much as that has to be checked, there is a point here that minor errors or deviations cannot affect. As much as the tenders, some tenders may not meet all the mandatory requirements as a result of deviations or oversights, then if they are minor, and minor or deviations or errors are determined by looking at the effect of the errors or omissions on the substance of the tender. If they do not materially depart from the requirements, then the errors, the tender will be deemed to be responsive. That is responsiveness of tenders. So we've done submission and receipt, opening procedures we've gone through. We've looked at the responsiveness. Let's now consider evaluation of tenders. Evaluation of tenders. Evaluation of tenders. This again is a process, evaluating the tenders. The tenders have been received. They've been taken through the test, responsiveness of tenders. Then the next obvious stage is evaluation. Here, first of all, the accounting officer must set up an evaluation committee, a tender evaluation committee. Tender evaluation committee must be set up by the accounting officer, and the role or function of this tender committee is to evaluate and compare just evaluating and comparing. Evaluate and compare the responsive tenders other than tenders rejected. So you've seen at this point, responsive tenders are identified. Now when identifying responsive tenders, there could be tenders that are rejected because maybe they have they have errors that are not that are major errors, major deviations. These are tenders that materially deviate from the requirements of tender documents. So such tenders are rejected. So this committee that is set up to evaluate tenders is a committee that evaluates the tenders that were responsive, the responsive tenders. The evaluation committee appointed by the accounting officer evaluates and compares the responsive tenders other than the tenders rejected. And that is done using certain procedures and criteria. The evaluation committee carries out its work of evaluating and comparing using procedures and criteria set out in the tender documents and in the tender for professional services shall have regard to provisions of the Act and statutory instruments issued by the relevant professional associations regarding regulation of fees charging for services rendered. Do you understand? I'm saying that, I repeat, that the evaluation and comparison is done using procedures and criteria that is set out in the tender documents. Tender documents, all right? And also the criteria and procedure that is set out in the tender for professional services, which we are saying here shall also have regard to the provisions of the Act and statutory instruments that are issued by relevant professional associations regarding regulation of fees chargeable for services rendered. Do you understand? And here, number 3 are the requirements. The requirements that shall apply with respect to the procedures and criteria. Now, number 1, the criteria shall, to the extent possible, be objective and quantifiable. Criteria that is used should be objective and quantifiable. The criteria should be objective and quantifiable. That is 1. Number 2, each criterion shall be expressed so that it is applied in accordance with procedures taking into consideration the price, the quantity, the time, and service for the purpose of evaluating. Then number 4, we have the evaluation report. Evaluation report. The evaluation committee will then prepare an evaluation report containing a summary of the evaluation and comparison of tenders, and shall submit the report to the person responsible for procurement for his or her review and recommendation. So remember, candidates, that when people submit tenders, they submit tenders so that they can provide services, so that they can provide goods, or so that they can do certain work. So the evaluation committee compares the different submissions or tenders, and we've said that has to be done using an objective and quantifiable criteria. Then after doing the comparison based on the objective criteria, then the evaluation committee has to prepare a report called an evaluation report, containing a summary of the evaluation and comparison of tenders, and then that report is submitted to the person responsible for procurement for his or her own recommendations and review. Then number 5, this report is then submitted to the accounting officer for approval. Here the evaluation committee submits the report to the person in charge of procurement, a person responsible for procurement. Okay? It could be the head of procurement, to say head of procurement in the procuring entity. Then this head is supposed to make recommendations and review. After reviewing, then this report is then sent to the accounting officer. So approval by accounting officer in the procuring entity. Do you understand? The person responsible for procurement, this person here, head of procurement, does what? Sends they report to the accounting officer. The person responsible for procurement shall upon the evaluation, shall upon receipt of the evaluation report prepared, submit such report to the accounting officer for approval as may be prescribed in the regulations. So the cabinet secretary should come up with regulations on how these reports ought to be received. These are, this is subsidiary legislation. The Act, all right, the Public Procurement and Disposal Act gives the cabinet secretary the authority to prepare legislations under the subsidiary regulations under the subsidiary legislation, and here we're saying that the cabinet secretary should prepare regulations, prescribe regulations on how the head of procurement is to submit the evaluation report to the accounting officer as may be prescribed in regulations. Then there is an important point on the time. There ought to be a time frame. This evaluation of tenders has to be carried out within a maximum of 30 days. Maximum of 30 days. There is a time limit of 30 days, maximum. It's a limit. Upon appointment to evaluate tenders, then the evaluation committee has only 30 days to do that work. Then lastly, there is signing. Each member of the committee should sign the signing of evaluation report by members of the evaluation committee. Signing of evaluation report by members of the evaluation committee. That is evaluation. Then we move on to post-qualification stage. Section 83 of the Public Procurement and Asset Disposal Act talks about post-qualification. And in post-qualification, an evaluation committee may, after tender evaluation, but prior to the award of the tender, conduct what we call due diligence and present the report in writing to confirm and verify the qualifications of the tenderer who submitted the lowest evaluated responsive tender to be awarded the contract in accordance with the Public Procurement and Asset Disposal Act. Do you understand? We've just done the evaluation. There is an evaluation report that has been presented to the accounting officer. So here we're saying that an evaluation committee, which we've been describing, may, after tender evaluation, but prior to the award of the tender, prior to the award of the tender, prior to the award of the tender. Prior means before. Prior to the award of the tender, before the tender is awarded. The evaluation committee can conduct due diligence. The evaluation committee may conduct due diligence. May conduct due diligence and then present the report in writing to confirm and verify the qualifications of the tenderer who submitted the lowest evaluated responsive tender. The lowest evaluated tender. Because when parties are tendering, they are submitting their tenders. The purpose is to maybe do some certain work or provide goods or provide services. Each tender has a price. So when carrying out evaluation, the evaluation committee we are saying here can carry out due diligence and present the report in writing to confirm and verify the qualifications of the tenderer who submitted the lowest evaluated responsive tender. So due diligence is restricted to the lowest evaluated responsive. Let me just have it. Responsive tender. Lowest evaluated responsive tender. Due diligence is restricted to that very one, lowest. And that is the tender that is to be awarded the contract in accordance with the Act. Now, the due diligence may include obtaining confidential references from persons with whom the tenderer has had prior engagement. Now, the purpose for carrying out evaluation of tenders is to identify the lowest evaluated responsive tender. Now, once the evaluation committee has narrowed down on the lowest evaluated responsive tender, then the committee can carry out due diligence, can get more information about this tenderer from references, from persons with whom the tenderer has had prior engagement. And to acknowledge that the report, this is the report on due diligence, to acknowledge that the report on due diligence, is a true reflection of the proceedings held, then each member who was part of the due diligence by the evaluation committee is expected or required to initial each page of the report. And candidates, this is the due diligence report. Other than initialing each page of the report, the members who carried out the due diligence are also required to append their signatures as well as their full names and designation. That is what is done post-qualification. After the evaluation has been done and the evaluation committee has identified a person who can be awarded the tender, all right, awarded the tender, and the one to be awarded the tender is most likely to be the one who quoted the lowest price. Okay, tender price. So due diligence is carried out, and so that's a procedure. Post qualification. Then there is number 9, professional opinion. Professional opinion. Professional opinion. Professional opinion. That is section 84 of the Public Procurement and Asset Disposal Act. The head of procurement function of a procuring entity alongside the report to the evaluation committee as a secretarial comments, reviews the tender evaluation report and provides a signed professional opinion to the accounting officer on procurement or asset disposal proceedings. Do you understand? The head of procurement function, because in a procuring entity, it could be the county government, it could be a ministry, it could be a department. Let's take, for example, a ministry. In government, we have the head of procurement function, then we have the accounting officer who may be the permanent secretary of a ministry. So the head of procurement function of a procuring entity, which could be a ministry, all right, alongside the report to the evaluation committee, all right, as secretarial or secretariat. As secretariat may comment, review the tender evaluation report, and then provide a signed professional opinion. And that opinion is to be sent to the accounting officer. Okay? And another point to note here, candidates, is that the professional opinion may provide guidance on the procurement proceedings in the event of dissenting opinions between the tender evaluation and award recommendations. You need to understand that there are various parties involved in this process. Let me take you back to the evaluation of tenders. You recall that the evaluation is done by a committee. It's known as evaluation committee here, which follows a certain procedure. Then this committee submits an evaluation report to head of procurement. So you see, we have a committee which could be having 3 or 5 of such members. Then there is also the head of procurement. This head of procurement is to go through this report and make recommendations, his recommendations, which could be different from recommendations made by the committee. Then this report, evaluation report that the head of procurement is expected to make recommendations on should be approved by the accounting office. That's a different person. Then there is also the procedure we are calling post-qualification. Prior to the award of the tender, the evaluation committee may conduct due diligence. Now, in conducting due diligence, the evaluation committee obtains information from referees or references, confidential references from persons whom the tenderer has had prior engagement. So you may find that a committee may settle on the lowest evaluated responsive tender, but gets conflicting information from the confidential references. That's why it's important to seek what we call professional opinion. Do you understand? Yeah, there could be dissenting views. The lowest evaluated responsive tender has been selected, but not every party involved in the process is in agreement that that ought to be the one to be awarded the tender. And therefore, there could be a process known as seeking professional opinion. And you're saying here, the head of procurement function of the procuring entity shall, alongside the evaluation report, provide assigned professional opinion to the accounting officer, because at the end of the day, it is the accounting officer to sign the. See how we said signing of evaluation report by the accounting officer. The accounting officer is required also to sign the report. Now, the purpose for having a professional opinion is so that the opinion can provide guidance on the procurement proceedings in the event of dissenting opinion or opinions between tender evaluation and award recommendations. And in making a decision to award a tender, the accounting officer shall take into account views of the head of procurement in the signed professional opinion. So the professional opinion is given by the head of the procurement function. That is professional opinion. Then, of course, there is now step number 10, recommendation of tender award. Recommendation or recommendations of tender award or award. Now, on recommendation of the tender award or contract, there isn't much to be said here, because what is done here is that subject to prescribed threshold, all tenders are evaluated by the evaluation committee of the procuring entity for the purpose of making recommendations to the accounting officer through the head of procurement to inform the decision of the award of contract to the successful tenderers. So we have evaluation committee, which decides who is to get the tender, but that has to be done through the head of procurement, whom we said again may be required to provide a professional opinion after due diligence has been carried out post-qualification by the evaluation committee. So subject to prescribed threshold of all tenders to be evaluated by an evaluation committee. This is evaluation committee of the procuring entity. For the purpose of making recommendations to the accounting, this is through, I'm saying, making recommendations to to the accounting officer through head of. So the finally recommendations are to be made to the accounting officer but through the head of procurement. So the evaluation committee submits the recommendations to the head of procurement. Then finally, it is the accounting officer of the procuring entity to approve the tender, the lowest evaluated responsive tender. All right? So these recommendations are made to the accounting officer through the head of procurement to inform the decision of the award of contract to successful tenderers or tenderer. So the last point here is successful tenderer. Successful tenderer or tenderers. Successful tenderer or tenderers. Now, the successful tenderer shall be the one who meets any of this, the requirements or who meets the specified requirements in the tender documents. Because when we studied the tender documents, we saw that the standard tender documents should provide all the information that is required by the tenderers in submitting tenders. There are requirements that are stipulated in the standard tender documents. So the successful tenderer or tender shall be the one who meets the specifications one being that of the lowest price, the tender with the lowest evaluated price. So a successful tender is one who quoted the lowest evaluated price. A lowest evaluated price. Another score here or point is the responsive proposal with the highest score. The one with the highest score. Okay, the proposal with the highest score determined by the procuring entity by combining for each proposal in accordance with the procedures and criteria set out in the request for proposals. We are saying here the scores assigned to the technical, scores assigned to financial proposals. So all those aspects have scores. So the tenderer with the highest score will also be the successful tender. Score in accordance with the procedures and criteria set out in the request for proposals. The one with the highest technical score, C. So here is a total score, but the successful tenderer should also have the highest technical score. Here we have many aspects like the financial score and so on, but the successful tenderer should be one with the highest technical score, the highest technical score. The tender with the highest technical score. Now, that is where a tender is to be evaluated based on procedures regulated by an Act of Parliament which provides guidelines for arriving at applicable, say, professional charges and so on. Then it ought to be the tender with the highest, the lowest evaluated total cost of ownership. Lowest evaluated total cost of ownership. So lowest evaluated total cost of ownership. So candidates, in determining a successful tenderer, all these factors should be considered or are considered. And for the avoidance of doubt, citizen contractors or those entities in which Kenya citizens own at least 51%. These are shares, at least 51% shares. They are entitled to 20%. They are entitled to 20% of their total score in the evaluation, provided the entities or contractors have attained the technical score. The technical score. So citizen contractors or those entities in which Kenya citizens own at least 51% shares, then they are entitled to 20% of their total score in evaluation, provided that they have attained the minimum technical score as set out in the regulations. And that brings this lesson to an end. We've been discussing the tendering process and selection of suppliers in the public sector. We identified 10 stages as per the Public Procurement and Asset Disposal Act. The first stage being standard tender documents. We talked about the tender documents. We explained the tender documents. Then the rest of these stages, there are also processes in registering of suppliers, invitation to tender, submission and receipt of tenders, opening of tenders, responsiveness of tenders, evaluation of tenders, post-qualification. We have the professional opinion, recommendations of the tender awards, then selection of successful tender. Thank you for attending the lesson. I hope you learned something, and that you are able, by the end of this lesson, to outline the tendering process and selection of suppliers in the public sector. Try to write notes, put down notes, go through the videos, revise the notes. You should be in a position to outline the tendering process in the public sector. Who knows? You may be the next one to win some tender down the road. So it's important for you to have the information as far as tendering is concerned in the public sector. If you have any questions, feel free to ask. Below this video, there is a comment section where you can place your queries, and all your queries will be answered. Now, in our next session, we are going to study the concept of e-procurement. Thank you. God bless you. Bye.
Hi students, welcome to another session of Manifested Online Classes. My name is Joseph Kimani, lecturer for financial reporting and analysis. So in this session, I want us we continue with the topic number 3 with a special focus on subtopic number 5 regarding presentation or preparation of financial statement by cooperative societies. But before you look on the financial statement which a cooperative society need to prepare at the end of the year, we need to know what is a cooperative society, why is a cooperative society formed, and so on. Now, a cooperative society basically refers to an association or an organization which is formed in order to promote the economic well-being of its members. Basically, what that means is that a cooperative society here is not formed in order to provide services or basically in order to sell some goods now to the members of the public with an objective of making profit. So meaning that a cooperative society here is actually formed in order to promote now the economic well-being of the members. So therefore you can say that a cooperative society yes, so therefore in that case you're saying that a cooperative society here will be formed will be formed in order to do what? To promote now the economic well-being of its members and not to provide services or basically to sell goods now to the members of the public in order to do what? To make profit. So mean that whenever, for example, maybe a number of individuals come together, they decide to form something like a SACCO. Basically, a SACCO is a good example of a cooperative society. And we know that those particular members will be forming that particular SACCO in order to make some savings. And if one of the member maybe require a small loan, then he can be able to come to that particular SACCO and be able to do what? To borrow that particular money. So meaning that the objective of forming that SACCO is to promote now the economic well-being, to promote now the economic welfare of who? Of the members. Now, whenever a cooperative society is to be formed, a cooperative society is formed and also registered in accordance with something called the Cooperative Societies Act. And basically, once a cooperative society has been registered in accordance with that particular act, then it is recognized as a legal entity, meaning that a cooperative society do have the same status just like a company. A cooperative society can be able to own property. It do have what we refer as a contractual capacity. It can enter into contract on its own name. It can sue or be sued. It can own property and so on. So therefore, a cooperative society do have the same status, just like what? Just like a company. It is a legal entity. Now, according to the Cooperative Societies Act, we have three types of cooperative societies which can be registered or which can be formed in accordance with that particular what? Act. So therefore, in this case, we can look on the different types of cooperative societies, types of cooperative societies, which may be registered in accordance with what we refer as the Cooperative Societies Act. Number one, we have something called a primary society. A primary society. So when talk about the primary society, this refers to any cooperative society which is formed by individual members. And according to the Cooperative Societies Act, for this particular cooperative society to be formed, it must be formed by a minimum of 10 qualified persons. And actually, for a person to qualify to be a member of a cooperative society, according to the Cooperative Societies Act, such a person need to have attained the age of 18 years. Number two is that such a person must be a resident or basically must own land within the cooperative society's area of what? Of operation. And number three is that that particular person must be within the profession, within the employment within which now the cooperative society is operating. So mean that if, for example, a cooperative society is formed like a coffee farmers, for any person to qualify to be a member, then such a person must be a coffee what? A farmer. So therefore, it is important to note that primary societies are those particular cooperative societies here, which we are saying are formed by individual members. And also we are saying that according to the Cooperative Societies Act, for this particular cooperative society to be formed, it must be formed, or basically it is formed by a minimum of 10 qualified members, or basically 10 qualified persons. Number two, we have something called the secondary cooperative society, or basically we can refer to it as the cooperative union. Cooperative union. In other terms, it can also be known as a secondary society or a secondary cooperative society, and this is a particular cooperative society which will be formed by 2 or more primary societies. So mean that members of 2 or more primary societies may come together and they decide to register now a certain cooperative society. That cooperative society now which will be registered or basically which will be formed, then we say it is formed by a primary society. So therefore, cooperative union is that particular cooperative society which is formed by 2 or more primary primary societies, 2 or more primary societies. Number 3, or the other type of cooperative society is something known as the cooperative union. So when talk about the cooperative union, this refers to that particular cooperative society which is formed at the national level, basically to promote the growth and the development of what we refer as the cooperative union. So therefore, it is formed at the national level. The objective of forming this particular cooperative society is to promote the growth and the development of cooperative union. A good example of this particular cooperative society in Kenya is what we refer as KUSCO. KUSCO basically is a cooperative society which is formed at the national level to be able to promote the growth and development of cooperative union. So we can say yes, so therefore, what we refer as a cooperative union. Okay, cooperative union, we can use the word Apex Society. Let's rename this. The appropriate name for that, sorry, should be Apex Society. Apex Society, sorry for that, not cooperative union. So therefore, Apex Society, we are saying, is a particular cooperative society which will be formed at the national level to be able to promote now the growth and also the development of what we refer as the cooperative union. So therefore, according to the Cooperative Societies Act, we have those 3 types of cooperative societies which may be formed and also registered in accordance now with the Cooperative Societies Act. Now, our main focus here, as the topic suggests, is basically preparation of a financial statement of cooperative societies. And therefore, which are the financial statements which are prepared by a cooperative society? So we can look on those corporate financial statements. Financial statement prepared by cooperative societies. First of all, it is important to note here that when we talk about the financial statements, we are talking of the final accounts which are prepared by cooperative societies at the end of the year to basically ascertain their performance, to ascertain their financial position. In this case, we have 3 final accounts, 3 financial statements which are prepared by the cooperative societies, and those financial statements include, number 1, what we refer as the income statement. Statement, which is also known as a statement of profit or loss. And number 2, we have what we refer as the appropriation account. And number 3, we have a statement of financial position. Financial position. So these are the final accounts which any cooperative society need to prepare at the end of the year. So let's start by looking on what is an income statement and why a cooperative society need to prepare the income statement. So number 1, we have the income statement which we also referring to a statement of a profit or loss. And as the name suggests, a statement of a profit or loss, or basically what you're referring to as an income statement, this one is prepared to determine the performance of a cooperative society. So mean that in preparing the income statement or the statement of profit or loss, basically what the cooperative society will be doing is basically comparing the income of a given financial year and what refers as what the expenses or the expenditures incurred during that year. Any difference between the two is actually a profit or what or a loss. So therefore you can say that this is prepared. It is prepared to ascertain financial performance. Financial performance of a cooperative society. Of a cooperative society. In other terms, we can say just prepare to ascertain the profit or loss of a cooperative society in a given financial year. So how do we prepare, or how is this statement of a profit or loss presented? So let's look on the format or the layout of what if as a statement of profit or loss. Statement of profit stroke loss. Automatically is the one is prepared for a certain year. Yes, so here always we start by recording incomes of the cooperative society. Incomes of a cooperative society. A cooperative society may have various sources of incomes, including things like investment income, and we prepare this account on using vertical format. So a cooperative society may be having something like investment income, things like interest on loans to members. So whenever a cooperative society gives members loans, like a SACCO, the cooperative society or basically the SACCO will charge some interest. That interest is basically what? An income. So also a cooperative society may be having the other source of income like entrance fees. If you are you want to join a cooperative society, you may be required to pay some fee. So these are some of the good examples of the incomes of a cooperative society, and then from there you get incomes, the total incomes, and then now to this we proceed and less the expenditures. Less the expenditures, or basically the expenses of the cooperative society. And here we basically deduct now the expenses incurred by the cooperative society in a given financial year. This will include things like maybe salaries and wages to the staff, things like management committee allowances, So a cooperative society is managed by a top organ known as management committee. Things like what? The interest on members' deposit. Cooperative societies, mostly SACCOs, they pay interest which is based on members' deposit, because the SACCOs want to encourage members to continue saving with that SACCO. So at the end of each year, as a member, you are paid some interest which is based on your what? On your deposit. So we take into account that. Then we also take into account other expenses like rent, etc. So we take into account all the expenses of the cooperative society, and we less that now from the total income. So whatever you get here is now the profit for the year. So that's how a statement of profit or loss, or an income statement of a cooperative society is presented, or is what? Prepared. So next, let's look on what is the appropriation account and why an appropriation account is prepared. Yes, number 2, we have a appropriation account. appropriation account. So as the name suggests, this is basically an account or a final account which is prepared by cooperative societies to show how the profit for the year is supposed to be distributed to the various stakeholders. For example, this account is prepared to show how much amount was paid to the members as dividends, and also how much amount was set aside as statutory reserve fund. Now, it is important here for you to note that under the Cooperative Societies Act, cooperative societies, mostly SACCOs, are required to set aside 20% of their profit as a statutory reserve fund. So therefore, that amount which has been transferred from the profit to the statutory reserve fund, in accordance with the Cooperative Societies Act, it is also shown in this particular account. And therefore, you can say that yes, so this one is prepared to show how the profit for the year was distributed to various stakeholders in form of dividend, in form of transfer to the statutory reserve fund, and so on. So how do we prepare this particular account here? So we can look on the format of the appropriation account. Yes, so in preparing the appropriation account here, always you start with that particular profit for the year, which was determined after preparing now the income statement. Profit for the year, that's what we start with always. And then to this, we proceed and we less dividends which were paid. So if there are some dividends now which were paid, we come, we less those particular dividends here. We also deduct the transfer to the statutory reserve fund, and in this case I've said that the statutory reserve fund, the amount to be transferred to the statutory reserve fund, this one according to the Cooperative Societies Act is always 20% over the profit. 20% over the profit for the year. So the examiner may have given that particular information to you, but equally, if you're given a question for cooperative society, that information still is missing. You have to note that 20% is a must, that 20% of the profit for the year must be transferred to something called the statutory reserve fund. And then after deducting those two items, what we do is that we get now the retained profit for the year. The retained profit for the year. To this retained profit for the year, we add the retained profit balance brought down. The retained profit balance brought down. This is the profit which was retained in the previous year. And then whatever you get down here is the retained profit, which is also known as the appropriation account balance. Appropriation account balance carried down. And this particular balance which we have here, this one will be transferred to the statement of financial position as a component of equity. So this one is transferred to statement of financial position as a component of equity. As a component of what? Equity. So basically that's how the appropriation account is prepared. You can see it is basically prepared to show how now the profit for the year, the profit which was reported during the year was distributed now to the various stakeholders. Finally, I want us to look on how we prepare the statement of financial position. So number 3, statement of financial position. Now, when talk about this one, statement of financial position, formerly known as the balance sheet, this one is prepared to show the financial position of a cooperative society at the end of the. In other terms, this is a statement of asset, liabilities, and equity, and this one always has to be prepared based on something known as the accounting equation. So we can say that this. Yes, so therefore this is a statement of cooperative societies assets, liabilities, and equity as at the end of the year. As at the end of the year. On the other hand, we can say that it is prepared based on the accounting equation. Yes, so therefore this one we prepare it based on the accounting equation. The accounting equation is an equation which states that assets are equal to capital plus liabilities. Equal to capital plus liabilities. So let's look on the format. How we prepare a statement of financial position. And actually this one we abbreviated as SOFP. Statement of financial position, which is prepared as at the end of the year. Prepared as at the end of the year. So always we start by recording assets. And when preparing a statement of financial position for a cooperative society is not a must. There is no need of classifying the asset into non-current and current. Just like what the banks do, we record the asset of the cooperative society starting from those assets which are liquid. When talk about assets which are liquid, we are talking of asset in form of cash, and then followed by those assets which are highly liquid, those assets which can be converted into cash within a short period of time, and finally we record now the long-term asset like the PPE and so on. So therefore, we start by recording assets. In this case, I've said we don't classify the asset into non-current and what? Current. So when recording the asset, what is important here is you start with most liquid assets. Most liquid assets, and finally record long-term assets. So meaning that here we start by recording things like the cash and bank balance. And then next we record things like investments. We also record things like loans to members. Whenever something like a SACCO has given the member some loan, that is an asset. The cooperative society expects the members to repay back those particular loan. And then you finally record the long-term asset, such as now the PPE, property, plant, and equipment. So therefore, I've said here, no need of classifying the asset into non-current and current. And then from there, get the total assets. Next, we record now the capital and the liabilities. And remember what I've said is that the cooperative society here do have the same status just like a company. So therefore, for capital, we record, or the capital, which is also known as equity, is comprises of share capital, things like members' deposits, and the reserves. So therefore, let's look on what we record under equity. So next we record equity. And equity, I've said that this comprises of share capital and what? Reserve. So we record the share capital. We also have the members' deposits. So it is important to note that if maybe the cooperative society we are dealing with is something like a SACCO, members will have made some deposit with such a SACCO. But generally, as a member of a SACCO, you can't be able to withdraw that particular amount of money anytime you want. So you can only be able to get back that particular amount of money if now you do what? You want to quit from that particular cooperative society. So mean that particular amount of money which you have deposited with your SACCO remain with the SACCO. The SACCO uses that as capital because mostly SACCOs use that money in terms of giving loans to members. And that's why you can see we are treating that as part of capital. As part of what? Capital. So we record other items of equity like the statutory reserve fund, statutory reserve fund. I've mentioned something to do with this. And then things like the appropriation account, and other reserves like the revaluation reserves, etc. Yes, so those are the various items of equity. And then get the total equity there. Get the total equity. And finally, record liabilities. Equally here, when recording the liabilities of a cooperative society, no need of classifying them into non-current and also what? Current. You just record all the liabilities here, which include things like what? Things like creditors. Things like creditors, the amount of money which is owed to the creditors, any accrued expense, etc. Yes. So record all those particular liabilities there and then proceed. You get what? The total equity and liabilities. Total equity and liabilities. And whatever you get here is the total equity and liabilities, always it must be equal to the total asset, simply because we prepare that statement of financial position based on the accounting equation which states that assets are equal to capital plus what? Liability. So therefore, that's how we prepare or basically present this particular statement of financial position of a cooperative society. So that brings us to the end of that session. In our next session, still in this on this particular subtopic here, we are going to look on an illustration question regarding presentation or preparation of financial statement of a cooperative society. So see you in the next class. Hi students, welcome to another session of Manifested Online Classes. So in this session, I want us we continue with the topic number 3, subtopic number 5, financial statement of cooperative societies. And specifically on this session, I want us we look on an illustration question regarding presentation of financial statement of a cooperative society. So I want us we go through the illustration and then we see what was required. So we are told Marura Farmers Cooperative Society deals in marketing of two brands of coffee, Safi and Mzuri, on behalf of the members. As per the society's bylaws, the society is allowed to retain 20% of the sales for Safi and Mzuri for operation and pay the balance to the members. The following trial balance was extracted from the books of the society as at 31st of December 2021. We have a trial balance there. We have expenses relating to Safi, which include marketing expenses, processing materials, processing wages, and then we have expenses relating to Mzuri, which include marketing expenses, processing materials, processing wages. Then we have loans to members. We have dividends from investment, accrued lends, salary provision, appropriation account, revaluation reserve, statutory reserve fund, entrance fee, share capital, members deposit, salary creditors, bank overdraft, interest on loans to members, and then we have traveling expenses for staff, for committee members, bank charges, bank interest, salaries and wages, committee education, committee seating allowance, printing and stationery, general meeting expenses, members education, entertainment, legal fee, cash in hand, Wakulima Bank Limited savings, investment in Wakulima Bank Limited, receivables from members, receivables from non-members, and then finally we have equipment. Then we have some additional information. Number one, we are told Bora Limited market Safi and Mzuri brand for Marura Limited. On 31st of December 2021, Bora Limited sold Safi and Mzuri brands for $175,000 and $115,300 respectively. Bora Limited remitted the above amount to Marura Farmers Wakulima Bank on 15th of January 2022. Marura Farmers Cooperative Society does not maintain a US dollars account in Wakulima Bank. So as far as that information is concerned, it is important to note that this company, which is called Bora Limited, which you are told market Safi and Mzuri Brads on behalf of the cooperative society, this is like an agency. This is just like KTDA, which is responsible for marketing and selling tea on behalf of various tea factories. So once KTDA sell tea, it remit now money to the bank account of various tea factories, and then which will be able now to pay their farmers. The same case with this particular Bora Limited is an agency of Marura a cooperative society. It market and do what? Sell those two coffee brand on behalf of that cooperative society. So therefore, once it sell, definitely it remit the money to the bank account of the cooperative society. But because you're given the sales in US dollars and the other figures are given in shillings, we have to translate those particular sales into Kenyan shillings, and automatically we're going to translate them using the exchange rate which was existing at the date the money was sent. I hope you can see we are told the money was sent or was remitted on the bank to the bank account of Marura Farmers Cooperative Society on 15th. So that is the exchange rate we are going to use. So in number 2, we are given the exchange rate for the two currencies, as shown below. So we're given the exchange rate on 31st of December 2021, which was 105 shillings, which was equal to $1. And then on 15th of January 2022, $1 was equal to 100 Kenya shillings. Automatically, in this case, I've said when translating the sales for the two coffee brand given in the information number 1, we are going to use the exchange rate on the date the money was remitted to the bank account. That is on 15th of January 2022. Number 3, we are told audit fee of 6 million is to be provided for. Number 4, salaries and wages amounting to 3.2 million had not been paid. These accrued salaries and wages. 5, interest on members' deposit is to be provided at shillings 6.08 million. And then finally, we are told, as per the relevant ministry's regulation, cooperative societies are required to transfer 20% of their net earnings to statutory reserve fund. This is something I mentioned in the first topic or in the first lesson of this particular topic, that cooperative societies are required to 20% of their net profit to a statutory reserve fund. So what are we required as far as that question is concerned? We are required to prepare the following financial statement for Marura Cooperative Society for the year which ended 31st of December 2021. Number 1, Safi Brad marketing account showing the profit and loss. Number 2, Mzuri Brad marketing account showing the profit or loss. And part C, statement of profit or loss for the year which ended 31st of December 2021. And finally, statement of financial position. So as far as the first two accounts are required, part A and part B, whereby you're required to prepare the marketing account of the two coffee brands, we're required to prepare those two accounts basically to show the profit or the loss which was realized from selling these two coffee branch. And what we are going to do, we are going to take now the sales, the sales of the 2 coffee brand, which is given the additional information number 1, and then there is some information which are given in paragraph 1 that this cooperative society is required to retain 20% of the sales of the sales and automatically remit the rest, which is 80% now to the members. So once we take the sales given in number 1 and we determine the amount to be retained, which is 20%, the amount to be paid to the members, which is 80%, then we are going to less now the expenses specifically relating to those 2 coffee brands. So we start with part A. Part A of that particular question. We are required to prepare a Safi, a brand marketing account, which is for the year which ended 31st of December 2021, 31st of December 2021. So in this case, we need to have just a single column here, and our figures are in thousands of shillings. So what do we start with here? We start with the sales from this coffee brand, and we are given that information in additional information number 1. We are told the sales from this coffee brand, that is a Safi, it was $175,000 US dollars. 175,000 US dollars, because these sales are in US dollars. So what we need to do, we need to translate this into Kenyan shillings. I've said we are going to use now the exchange rate when the money was remitted out to the bank account of the cooperative society. The money was remitted on 15th of January 2022, in which case now the exchange rate was 100 shillings, which was equivalent to $1 US. So we multiply that with what? With 100, so that we get the final figure here. So let's get the final figure. So this is 175,000, then times 100. So that will give us 17.5 million. Take into account our figures are in thousands of shillings. So that will be recorded there 17,500. Then what you are told is that out of these particular sales from these 2 coffee brand, now the cooperative society has to retain 20% to cater for the expenses associated with marketing and selling this particular coffee brand, and then 80% of these sales will have to be paid to the members, or basically to be distributed to who? To the members. So therefore, the first thing we need to do, even before we less now the expenses. So first of all, we have now to deduct amount due to members. And basically in this case, we have said the amount due to members is 80%. Amount due to members. That amount due to members in our case, we have said, is 80% of these sales, because we are told the cooperative society is supposed to retain what? Supposed to retain 20%. So what is 80% of 80% of this? 80% of 17,500, which will give us 14,000. So this is the amount now to be paid to the members, meaning that the amount retained by the cooperative society, and which is now 20%, is how much? Is 35. So basically what that means is that this particular amount should be equal to, 20% of this. Maybe you can just confirm 20% of 17,500. That should give us 35. That is the amount to be retained by the cooperative society to cater for the expenses associated with marketing and selling this coffee brand. So then what we need to do is basically to go ahead and less now the expenses. We less the expenses. So we are given the expenses, or we're given specific expenses relating to marketing and selling this coffee brand, and those particular expenses are given in the trial balance. I think the first item in the trial balance, we have the expenses associated with marketing and selling Safi. So we have marketing expenses. marketing expenses, which is an amount of 640. We also have processing materials, an amount of 860, and then we have processing wages, which is an amount of 900. Yes, an amount of 900. So wherever you get down there is basically now the profit which this particular cooperative society was able to get from selling this coffee bread. So 35 minus 640 minus 860 minus 900. So this will give us 1100, and basically this is now the profit for the year from selling and marketing this particular coffee brand. So basically that's what the examiner was requiring there, and you can see how many marks were allocated there. The marks allocated were 3. So for recording basically these particular items here, the sales and these particular expenses here, then you had to get those 3 marks. So let's move to part B of that particular question, part B of that question, and we are required to prepare now a marketing account for the other coffee brand, which is Mzuri brand marketing account, which is equally for the year which ended 31st of December 2021. So our figures are in thousands of shillings, and we're following the same format. We start with the sales of this particular coffee brand, and that is given in the additional information number 1, which was 115,300, but this take into account our US dollars. We have to translate that to Kenyan shillings using the exchange rate which existed on the date this money was remitted to the bank account of the cooperative society, and this will give us 11,530,000. So just like what you have done here to this, we need to less the amount due to members, the amount which was supposed to be paid to the members from this particular sales. So we less amount due to members. In this case, we have said the amount due to members is 80% of the sales. 80% of the sales. And then what we get here is the amount retained by the cooperative society to cater for the expenses associated with marketing and selling this particular coffee brand. So 80% of 11,530. Okay, we can take that again. 80% of 11,530. Yes, that will give us 92.24. That is the amount which was due to members. And then how much amount was retained here? We deduct that from 11,530, which will give us 23.06. So this is the amount which was retained by the cooperative society and which was supposed then to cater for the expenses associated with marketing and selling this coffee brand. And we are also given those particular expenses. Those expenses are given in our trial balance there. So what we just need to do is to record them here. So we have marketing expenses. An amount of 150. And then we have processing materials. processing materials an amount of 320, and then we have processing wages. Processing wages, which is an amount of 30. Yes. And then from there, what we do, we get the profit for the year. The profit for the year from this coffee bread. So what do we have here? We have an amount of 2306 minus 150 minus 320 minus 30. That gives us 1806, which is now the profit for the year. Equally, that is what was required as far as part B of that question was concerned. And these are some of the items which were marked as far as that part is concerned. And by doing that, you get now your three marks. So let's move to the other part of that particular question, that is part C. But even before we do that, there is something we need to note here, which is very, very important. One, when the year was coming to an end, this particular agency, remember we have said that this cooperative society has an agency which is called what? Bora Limited. As per the information given in note 1, this agency had not limited this amount of money to the bank account of the cooperative society as at the end of the year. So therefore, this amount here, 17,500, and also this one, 11,530, it was an amount which the agency owed to the cooperative society. So therefore, in preparing our statement of financial position, this particular amount plus that one, because it is the amount which the cooperative society was expecting, it will be recorded there as an asset. So basically, we refer to that as the amount now to be received, or the amount receivable by the cooperative society from that agency. On the other hand, this particular amount which was due to the members, 80%, this amount was not yet paid to the members of the cooperative society when the year was coming to an end. And therefore, in preparing our statement of financial position, this one will be recorded there as a liability, because this is what the cooperative society was supposed to pay to the members. It had not paid that amount. So therefore, it is important to note that. Let's move to part C of that question. In part C, we are required to prepare now a statement of profit or loss for the year which ended 31st of December 2022. Now, this one is prepared to determine the profit or loss for the entire cooperative society. Remember, what you have prepared in part A, part B is prepared to determine the profit from marketing and selling the two coffee bread. So part C, we are required to prepare a statement of profit or loss, which is for the year which ended 31st of December 2021. 31st of December 2021. So in this case, we need to have two columns. And we prepare these by comparing the incomes of a cooperative society with the expenses. Automatically we start with the incomes and then we less the expenses. So which are some of the incomes of this particular cooperative society? So even before we go back to the trial balance, because we know our cooperative society is responsible for marketing two coffee breads on behalf of the members, we know that from marketing of the two coffee bread, there was a profit of 1,100 from marketing and selling of Safi, and 1806 from marketing and selling of what? Muzuri. So that is the first source of income to this cooperative society, and that is what we bring here. So profit from the two coffee bread, Safi, which is a figure of what? Of 1100. And then we also have the profit from the other coffee brand, which is Mzuri, a figure of 1806. Then what we need to do, we go back to the trial balance, we take the other incomes of this cooperative society. It's important for you to remember all incomes have a credit balance. So when checking for incomes from the trial balance, you check the items on the credit side of the trial balance. So the items on the credit side, I think the first item, we have dividends from investment, dividends from investment. Dividends from investment is a figure of 470. Below that, we have accrued rent. Accrued rent, these are liability. Thirdly, creditors is a liability appropriation account. This is like the retained profit at the start of there, which is not an income. Revaluation reserve is a component of equity. Statutory reserve fund is a component of equity. And then below that, we have entrance fees. This is still an income to a cooperative society. And this entrance fees is a figure of what? Is a figure of 300. Below that, we have share capital, members deposit. None of those is an income. Salary, creditors, bank overdraft. All those are items of liabilities. And I think finally we have interest on members' loans. Interest on members' loans. Members or interest on loans to members. Remember what you have said is that once a cooperative society give loans to the members, a cooperative society definitely will have to charge some interest. That interest charged by the cooperative society is basically what is an income. Yes, so I think those are the only incomes which we have. So then what we need to do is to get the total incomes. So let's add all those figures so that we get the total incomes. We have 1100 plus 1806 plus 470 plus 300 plus 35 890 890. Okay. Yes, that will give us the total incomes of 39,566. Yes, after getting the total incomes, what do we do next? We proceed and we list now the expenditures. The expenditures of these cooperative societies, expenditures of the cooperative society. So here we have a number of expenses, and before taking the expenses in the addition in the trial balance, it is always advisable first of all deal with the expenses affected by the additional information. Let's go to the additional information. In the additional information, number one, I think we had information about sales of the two coffee brands. That has nothing to do with the expenses. Number two, the exchange rate that do not affect expenses. And then number three, we are told audit fees to be provided for. Audit fee to be provided for, that is an expense. But equally, because we are told this audit fee was provided for, it means that when the year was coming to an end, this audit fee had not been paid. Meaning that in our statement of financial position, there is a liability. So we have audit fee of 6 million, but remember all our figures are in thousands of shillings. And then number four, we are told staff salaries and wages amounting to 3.2 million had not been paid. So we have staff salaries and wages. So what we do, we take the amount which was not yet paid at the end of the year, which is 32, and then we add to this, we add the amount which had already been paid, and this is the amount appearing in the trial balance. So the amount appearing in the trial balance as the staff salaries and wages is a figure of what? Yes, is a figure of 2290. 2290. 9290. So we add the two figures, so that now we get the total staff salaries and wages for that year. So we have a figure of 3200 plus 2290. So the total staff wages and salaries for that year is a 5490. So let's go to note number 5. Interest on members' deposit is to be provided for. Remember, in this case, we have said that interest paid to members based on their deposit, this is an expense. This is an expense. And equally, it is also important to note that this amount are not being paid, it's just provided for. So therefore, still in preparing our statement of financial position, this will be a liability. So I think we are done with that point. And then number 5 is all about the amount to be transferred to the statutory reserve fund. That is not an expense. So what that means is that we go back to the trial balance which you are given, and we pick now all the other expenses. It's also important to note that all expenses in the trial balance, they have a debit balance. So we check the items on the debit balance, on the debit column of the trial balance, that is. And I think we can start from where we have traveling expenses. That, I think, where we have the first expense. It is important for you to note that we have some expenses which relate to these two coffee brand, Safi and Muzuri, and because we capture those particular expenses here in preparing this particular account, we don't take into account those particular expenses. Those expenses specifically relate to Safi and Muzuri. What we are recording here are the general expenses relating to the cooperative society. So we have traveling expenses for staff and committee members, a figure of 80 and 100. And then we have bank charges, an amount of how much? An amount of 200. We have bank interest, which is a figure of 890. Then below that we have salaries and wages. We have already dealt with that here. And then we have committee education, that is the other expenditure. Committee education, which is an amount of 1,000. Below that we have committee seating allowances. This is committee allowance. We have committee okay, this is a committee's education. Committee's education, which is 1,000. Then we have committee seating allowances, which is a figure of 1110. And then we have printing and stationery. So printing and stationery, we have a figure of 2050. And then we have general meeting expenses. General meeting expenses, an amount of 500. Below that we have members education. Members education is a figure of 1,500. And then below that we have entertainment. Entertainment is a figure of 50. And then next and finally we have the legal fees. Which is a figure of what? Of 400. So those are, I think, the various expenses which relate to this cooperative society. I hope we have not skipped any. Yes. So what then we need to do, we need to add all those particular expenses of this particular cooperative society, so that we can be able to determine the profit or what the loss for the year. So let's add all these particular expenses, starting from where we have audit fee. 6,000 plus 5490 plus 6086 plus 80 plus 100 plus 200 plus 810 plus 1,000 plus 1110 plus 2050 plus 500 plus 15 plus 50 plus 400. Yes, so that is giving us a total of 25, sorry, 376. So what we need to do, we need to less that now from the total incomes which we have here. We deduct that from 39,566. So that will give us the profit for the year. The profit for the year of 14,190. So basically that is it, that what is required as far as that part was concerned. Preparation of the statement of profit or loss, and in that case now the examiner had given how many marks? The marks were allocated to that were six. So by recording those particular items of incomes and expenses, you had to get now 6 marks. So finally, let's prepare now the statement of financial position as required in part D of that particular question there. So we prepare statement of financial position. Statement of financial position. That is part D. You can just refer to it as abbreviated as SOFP, as at 31st of December 2021. 31st of December 2021. So remember, you say that it is a statement of assets, liabilities, and equity. So we just need to have a single column here. And we start by recording assets. And remember what we said in our first session. As far as this is concerned, we don't need to classify the asset into non-current and current. We just record asset starting from the most liquid to the long term. And I think we are given the asset starting from where we had our last expense, the legal fee. Below that we have cash in hand. Cash in hand. The cash in hand is a figure of 540. Then below that we have Wakulima Bank. Wakulima Bank Limited savings, which is an amount of 6780. And then we have still investment in Wakulima Bank Limited. Wakulima Bank Limited, which is a figure of 6,550. Then below that we have receivables. We have receivables from members, which is a figure of 2,960. We also have receivables from non-members, a figure of 22,500. And then we also have office equipment. Office equipment is a figure of what? Is a figure of 900. Yes, so I think those are some of the items which we have in the trial balance. But I think also below the various expenses relating to Safi and also Mzuri, we have now the loans to the members. Remember, we have said that once a cooperative society has given loans to the members, advanced loans to the members, these particular loans to the members to a SACCO or even to a cooperative society is an asset. The cooperative society expects now the members to repay back that amount of money. So basically that is an asset. Then what else do we have maybe from the additional information? From the additional information, number one, we have now the amount which this cooperative society was yet to receive from the marketing agency, which is Bora Limited. So we can just refer to that as the amount due. Amount due. This is the amount which was not yet remitted to the bank account of the cooperative society by the marketing agency, which is known as what? Bora Limited. And this amount, because it is given in terms of US dollars, we have now to convert that now to Kenyan shillings. So we take the sales from Safi, 175,000 US dollars. We can just take it as 175. And then from the other Coffee Brand, 115.3. And then we get the total. We translate that now to the Kenyan shillings by multiplying that with the exchange rate on the date the money was remitted. So we have 175 plus 115.3 times what? Times 100. So this is the amount of money which now Bora Limited was yet to remit to the bank account of the cooperative society. So therefore to the cooperative society, this is basically an asset. So that's what we have in note number 1. Additional information, note 1. Note 2 has nothing to do with the sales. Note 3 is that is a liability. Note 4, that is still a liability. And then number 5 is still a liability. And then number 6, this one will affect now the appropriation account. I'll be able to show you now the necessary what? Adjustment we are going to make as far as that is concerned. Yes, so what we need to do here is to get now the total assets. So let's add all these assets starting from where we have 540 plus 6780 plus 26 550 plus 2690 plus 22,500 plus 900 plus 972 340 plus 29,030 030. Yes, that will give us a total figure here of 1,061,330. So those are the total assets. Next, we record now equity. Equity, this one comprises of a share capital, members deposit, plus the various items of what? Of reserves, of which all these items, they have a credit balance. So let's start by recording the share capital of this cooperative society that is given in the trial balance. Share capital is given as a figure of 900. So then below that we have members deposit. Members deposit, which is a figure of 64 650. Yes, and then from there we have various items of reserves, starting with just above the share capital entrance fee, we have statutory reserve fund. This one will need to be adjusted because whatever you given there as a statutory reserve fund, this is a statutory reserve fund at the start of the year. And then what you are told as per note number 6 is that 20% will 20% of the net earnings is the same with the profit for the year, will be transferred to statutory reserve fund. So this should be 20% of what? 20% of this profit for the year. 20% of that what profit for the year. So it should be 20% of 14,190. So that we get the statutory reserve fund at the end of what of the year. So then below that, or basically above that, we have revaluation reserve. Revaluation reserve that remain the same, which is a figure of 750. We're going to compute that figure. And still we have appropriation account. Appropriation account, this account still, or this figure still need to be adjusted, because what you're given there is the appropriation account at the start, which is what? Which is 50. To this, we should add the profit for the year. The profit for the year, remember, is 14,190, but equally we are going to less the amount which was transferred to the statutory reserve fund, which is 20% of 14,190. 14,190, and we get now the appropriation account balance at the end of the year. So I think we have picked all the items of equity. We have picked all items of what? Of equity. So I think what we just need to do here is to get now these final figures, starting with the statutory reserve fund. So let's first of all get 20% of this, 20% of 14,190 plus 13,740. That will give us 16,578. What about the appropriation account balance? So we have we have what? We have 6050 plus 14,190, and then to that we less what? We less 20% of 14,190, and that will give us 17,402. Yes. So those are the items of equity. So what we then need to do is now to get the total equity. Let's get the total equity by adding all these items, actually starting from there. We have 17,402 plus 750 plus 16,578 plus 64,650 plus 900,000. 900,000, which will give us 999,380. So that is the total equity. So what we need to do next, or actually finally, we need to record now the liabilities. We need to record the liabilities. The liabilities. So we have various items of liabilities. Let's start with what we have in the additional information. In the additional information, number 1, there is something, first of all, you need to remember that there was amount due to members. There was some amount which was, this cooperative society was supposed to pay to the members, which was 80% of this amount, which was from the sales of the 2 coffee bread. So we can just compute that as 80% of this, 80% of 29,030. Although if you go back to what we prepared in Roman 1 and also all part A and part B, you can be able to see the amount due to the members as far as the sales of the 2 coffee bread is concerned. If you add those, the amount from Safi brand marketing account, Mzuri brand marketing account, should be able to get the same figure here as 80% of the total sales of the 2 coffee bread. So we have 80% of 29,030, That will give us 23,224. This amount which this cooperative society was yet to pay to the members. So that's what we have in note 1. Number 2 is about exchange rate. Number 3, we have provision for audit fee. For audit fees, this amount was not yet paid. It was just provided for. So therefore, it is a liability, 6,000. And then number 4, we have accrued salaries and wages. Accrued salaries and wages is 3.2. And then below that, number 5, we have provision for interest on members' deposit. Members' deposit. Still, this amount are not being paid. It was purely provided for. That's why we are accounting for it as a liability there. I think with that what we have. Yes. So let's then go back to the trial balance and we pick now the other items of liabilities. Remember, all liabilities, they have a credit balance. So starting from where we have dividends from members, below that we have accrued rent. Accrued rent, which is 470. Below that we have salary provision. Salary provision 4950. 4950, and then down there we have salary creditors, which is a figure of 3410, and then we also have bank OD, bank overdraft of 6150. Yes, so I think we have recorded all items of liabilities. None of the item which you have not recorded. Yes. So what we just need to do here is now we get the total. Equity. Total equity and liabilities. So for the total equity and liabilities, we take the total equity there, and then we add all these items of liabilities. But first of all, we add these items of liabilities. We have 23,224 plus 6,000 plus 3,200 plus 60,86 plus 470 plus 4950 plus 3410 plus 6150. Yes, plus what we have there is 999 380. Okay, let me take that again. Okay, so we have what? We have 999 380, and then we have 23,224 plus 6,000 plus 32 plus 60,86 plus 470 plus 4950 plus 3410 plus 6150. Yes, so that is giving us the same figure there as 1061 330. 1061 330. So basically that is what was required in that part D of that question. These are the items now which were to be marked. But definitely that particular statement of financial position, as you can see, there are so many entries, entries, and basically by doing that, you are allocated 8 marks as far as that question is concerned. So that brings us now to the end of that particular illustration as far as the preparation of financial statements by cooperative societies are concerned. And I think that is the most recent question on cooperative societies. There is another question which was tested back in the year 2010. So if you can be able to access the past papers for 2010, you can be able to check a question which was tested. So I think was question number 4 from that particular sitting. So therefore, we stop at that particular point. See you in the next session as we move to a different topic. Hello students, welcome to Manifested Online Classes. My name is Joseph Kimani, a senior lecturer in financial reporting and advanced financial reporting. So today I want us we look on the paper which was tested in the April 2022, and the paper is advanced financial reporting. So we have already done question number 1, 2. So I want us we proceed to question number 3. And this particular question here basically had 3 parts. So part A was from IFRS 15, revenue recognition. Part B was about employees' benefits. And the other part C was concerning the earnings per share. So I want us we start with part A of that particular question, which was a theory question. And it reads, with regard to international financial reporting standard IFRS 15, which deals with revenue revenue from contract with customers, explain the key factors that should be considered when determining the transaction price within a contract. Within what? A contract. So this particular question was requiring you explain a number of factors which are supposed to be considered by a company in determining the transaction price as provided under IFRS 15. As provided under IFRS 15. So the question there, part A, was requiring you highlight key factors, that must be considered, or key factors to be considered, in determining the transaction price. The transaction price. Now, first of all, here, when talk about the transaction price, this refers now to the amount of money, or basically that particular consideration which is supposed to be paid by a customer once the goods have been delivered to such a customer, or once the services have been provided to such a customer. Now, which are some of the factors which are supposed to be considered in the terms of determining this transaction price which is now to be paid? So we have a number of factors which are supposed to be considered, and one of it is what you refer as the performance obligation, obligation to be satisfied. Performance obligation to be satisfied. So in this case, when talk about the performance obligation to be satisfied, we are talking of the goods which are to be delivered to a customer, or services which are to be provided to such a customer. That is the first thing the company should be able to consider in terms of determining the transaction price which is supposed to be paid by such a customer. Now, the other factor which also need to be considered is what we refer as the variable consideration. Variable consideration. In this case, when talk about the variable consideration, this is a consideration, or basically is that particular price which is not fixed. So basically what that means is that this particular price is dependent on a number of things which are likely to happen in the future. So in other terms, we can say that this particular consideration is what is contingent, and therefore in this case, the company, what will the company need to do here is to estimate this particular variable consideration, because you are saying that this particular consideration will depend with a number of factors. So therefore, the company in determining the transaction price to be charged, it basically need to estimate that particular word variable consideration. Number 2, or the other factor which also need to be considered here, is what refers as the non-cash consideration. Non-cash consideration. Now, what is a non-cash consideration? This is basically that particular consideration which is to be paid in other means other than cash. Other than what? Cash. For example, the customer may promise to pay a consideration which is in form of other asset other than what? Cash. So what the company should be able to do is to estimate the value of this particular consideration, of which IFRS 15 requires that the company should be able to estimate the value of such consideration using the fair value of the non-consideration to be given by who? By the customer. To be given by who? By the customer. And finally, number 4 is what we refer as the consideration payable by the customer. Consideration payable by the customer. So this is the other factor which will need to be considered. So before the company can be able to arrive at the final figure of the transaction price, the company should be able to determine how much is that consideration the customer will pay after the goods are delivered, or basically after the services have been provided. So therefore, what the examiner here was requiring is you highlight at least two factors, which now will need to be considered by the company in terms of arriving at that transaction price. And basically for each you get 2 marks. So let's move to the other part, that is part B of that question. And this came from the topic of employees benefit, which reads: the following accounting information was extracted from the financial records of Kibo Limited regarding the defined retirement benefit scheme for its employees. So what you are given, one, here we are given the net defined benefit obligation as at 1st January 2021. So we also given the net defined benefit obligation as at 31st December 2021. We also given the current service cost there, which is 200 million. We have the contribution to the scheme, the benefit paid by the trustee. Remember, the trustee here is a retirement benefit scheme. For example, when talk about NSSF is a trustee. So then you are told the market yield on high quality corporate board is at the rate of 5%, and then you're told assume there is no tax implication regarding the retirement benefit obligation. So from that information, what the examiner was required is, with suitable calculations, explain the accounting treatment of the various items of the defined benefit scheme on the financial statement of Kibo Limited for the year which ended 31st December 2021 in accordance with the IAS 19, which governs the employees benefit, So what was required here is, using suitable calculations, we explain some of the accounting treatment, or basically the accounting treatment of various items in the financial statement of Kibo Limited. So this is part B of the question, which was requiring we explain treatment of various items in financial statements of Kibo Limited, Limited. Now in this case we have a number of items which are supposed to be determined and accounted for in the financial statement of Kibo Limited. Essentially there are three items. Which are those items? One, we have something called the net pension cost, net pension cost, of which this net pension cost, this is supposed to be taken to the income statement as an expense. So the first item here is the net pension cost, net pension cost. And the other one is something known as the net actuarial, gain or loss. And number 3 is what we refer as the net defined benefit. Net defined benefit, we can just refer to this as net defined benefit. Benefit asset or liability. So these are the 3 items now which now a company which is operating a defined benefit scheme should be able to compute and basically account for in the financial statement at the end of the year. Now, first of all, this net pension cost, this one is accounted for as an expense. This one is accounted for as an expense in the income statement. Whereas this net actuarial gain or loss, this one is accounted for as part of other comprehensive income. Remember here, when talk about other comprehensive income, we are talking of other items of incomes or expenses, or items of incomes or expenses which should not be included as part of the profit or loss for the year. And then this net defined benefit asset or liability, this one should be accounted for in the statement of financial position as an asset. If the company has determined this and the company has gotten the net defined benefit asset, this one is accounted for as a non-current asset. Whereas a net defined benefit, we have said this should be net non-current asset, whereas a net defined benefit liability is accounted for as a non-current liability in the statement of financial position. So therefore, what we need to do, or what the examiner was requiring as far as that question is concerned, is you compute these 3 items and basically you also explain how they were supposed to be accounted for in the financial statement of Tibo Limited. So therefore, let's compute these 3 items, and I think we can start with the second one here, that is the net actuarial gain. After computing that, then we proceed. We compute the net pension cost and then the net defined benefit asset or liability. So let's start by determining this. We can just refer to it as, yes, we refer to this as net actuarial gain or loss. Net actuarial gain or loss. Now, how do we determine this particular net actuarial gain or loss? To determine this net actuarial gain or loss, there is the formula or the approach now which we use to compute this one. That is what you are supposed to remember. So to compute this one, remember our figures there are given in what? Are given in million of shillings. So we need to have a single column here. And what we start with here is what is known as the net defined benefit obligation. Balance brought down. So in this case, when talk about the net defined benefit obligation balance brought down, this is the opening balance, or basically what you're given there as the net defined benefit obligation on 1st January 2021, which is given as 1850. As 18 what? 50. Now to this, what do we add? To this we add something called the net interest cost. The net interest cost. Now this particular net interest cost we computed based on the rate which you are given there. If you go back to the question in the last paragraph there, we are told the high or the market yield of high quality corporate bond is at the rate of 5%. So in this case we take 5% of the net defined benefit obligation at the start. So we take 5% of 1850. So we get 85%. That is 5% of our net defined benefit obligation at the start. So 0.05 times 1850. So which will give us 92.5. 92 point what? 5. And then to this, what do we add? To this, then we add what we refer as a service cost, or what in other terms we refer to as the current service cost. The current service cost. The current service cost in our case here given that is an amount of 200 million. And then to this, after adding those two items, what we less here, sorry, not we less, yes, so what are we given there? We are given the contribution to the scheme, so we need to take into account that here, the contribution to the scheme, of which this contribution to the scheme, automatically this one should be what? Should be deducted. How much is that? Is 225. 225. Now what you need to note here is that if you're using this particular approach here of computing the actuarial gain or loss, whereby we are using the net defined benefit obligation. Remember, the net defined benefit obligation is the net amount of what you refer as the plan asset and the plan obligation. So if you're using this particular approach to determine the net actuarial gain or loss, we don't less the benefit paid here, because the benefit paid are deducted from both the plan asset and the plan liability. So that one should not be deducted here. But if we were to use now the other approach, whereby we compute the actuarial gain or loss in respect to a plan asset separately, and the actuarial gain or loss in respect to the plan obligation separately, remember we have to deduct the benefit paid. But when using this particular approach here, I've said we don't less. We don't do what? We don't less those benefits are paid. The benefits paid are not supposed to be what? To be deducted there. Are not supposed to be deducted there. Then what we need to do is to get what we refer as the expected net defined benefit obligation at the end of the year. So we take 1850 plus 92.5 plus 200, that is minus 225, and that will give us a 17.5. Then what we need to do to this is we need to compare it. We need to compare this with the net defined benefit obligation at the end of the year. And this is the amount which are given as 2,000. So basically we need to compare these two, and remember that a net defined benefit obligation is essentially a liability. So basically what this means is that the company expected that the defined benefit obligation, the net defined benefit obligation, to be 1970. This is expected. The expected net defined benefit obligation. But you can see, based on the actuarial valuation which was done at the end of the year, the net defined benefit obligation at the end of the year was determined to be what? 2,000. So basically we can say that there is an increase here in the value of liability. How much is our increase? We get the difference. The difference here is 82.5. 82.5, and because this is an increase, and also we have said that this is a liability, anytime the value of a liability increases, then that automatically is a loss. But in this case, remember, we are going to refer to this as what? As the net actuarial. The net actuarial, we have said this is an increase, and basically take into account this is a liability. This therefore will be what? Will be a loss, because anytime the value of a liability has increased, automatically that is what? Is a loss. Now this particular loss, or this net actuarial loss, is what you have said was supposed to be accounted for as part of other comprehensive income. So therefore we can go ahead and basically we give that particular explanation, because that's what the examiner was requiring. we say that the net actuarial loss, the net actuarial loss of shillings 82.5 million was supposed to be accounted for, accounted for as part of other comprehensive income, as part of other comprehensive what? Income. So that is the explanation which was required here, that the net actuarial loss, this figure which you have computed here of 82.5 million was supposed to be accounted for. This one was supposed to be accounted for as part of other comprehensive what? Income. Remember, you have said that the other comprehensive income, these are basically other items of incomes or expenses which should not be part of the profit, or these are incomes or expenses for the year which should not be part of what? The profit or loss for the year. Now, having determined that, we can proceed and we determine this net pension cost. Net pension cost. Net pension cost. Now, how do we determine this particular net pension cost? How do we determine this net pension cost? So to compute this particular amount of net pension cost, equally we take a number of items here. We take a number of items. One, we take this net pension cost. This net pension cost, net pension cost, how much is that? That is an amount of 92.5. This is an item of expense. We also add the current service cost. Current service cost. How much is that? Is 200. And basically, these are the only two items now which we take into account. But remember, when computing this net pension cost, in the event you are given the plan asset and the plan obligation separately, here you ordinarily have more items, because like in this, you should be having something called the interest cost and something called the expected return on plan asset. Now, this net pension cost is a net amount of those two items, interest cost and the expected return on plan what? Asset. Then you should have the current service cost. Already we have that. The past service cost, in our question we don't have the past service cost because there was no improvement which was done by this company. The company has not increased those pension to be paid to the employees in what? In the future. Essentially, there we should have around 4 items. I've said we don't have the past service cost, and then I've said that the net pension cost take into account the two costs. Take into account the two items, interest cost and the expected return on plan asset. So therefore, the net amount here, which is 292.5, this was supposed to be accounted for as an expense in the income what? Statement. So therefore, we can give that explanation here. The net pension cost, was supposed to be accounted for, as an expense, and specifically this net pension cost, because this is an employees related expense, it is accounted for as administrative. Expense in the income statement, supposed to be accounted for as an expense in the income statement or statement of a profit or loss. Statement of profit or what? Or loss. Statement of profit or loss. So therefore, that is the explanation which was required there. You explain that net pension cost of basically 292.5 million. This one was supposed to be accounted for as what? As an expense, specifically administrative expense, in the statement of what? A profit or loss. Finally, what we need to do is we compute the third item here, the net defined benefit asset or what? Liability. This is quite straightforward because the two items to be used here are given there. So let's compute that. The net defined benefit, net defined benefit asset or liability, benefit asset or liability, or liability. So how do we compute this? So to compute this one is quite simple and straightforward. Yes, so here we need to take into account only a single item which is already provided for us in this question, and that is now the net defined benefit obligation. Now this net defined benefit obligation at the end of the year is what was supposed to be taken to the statement of financial position of this company, and because it's a net obligation, is a net what? Obligation, that amount was supposed to be accounted for as what? As a non-current liability. And how much amount is that? The amount there is 200 million. Now this that is 2,000 million. Now this 2,000 million was supposed to be accounted for by the company as what? As a component of non-current liabilities. As a component of non-current what? Liabilities. So I think we can equally give that explanation here. We can give this explanation here, and we say that the net defined benefit liability, net defined benefit liability at year end is a non-current liability, in the statement of financial what? Position, is a non-current liability in the statement of financial position. So therefore this was supposed to be accounted for, or basically to be taken to the company statement of financial position as an item of what? Non-current liability, as an item of non-current what? Liability. So therefore that is it, that what was required by the examiner there. So the examiner basically required you to compute those three items: the net actuarial gain or loss, the net pension cost, and the net defined benefit obligation, and basically you explain how they were supposed to be accounted for. So that brings us to the end of our class. So we come back and then we look on the other part of that question.
Hello and welcome back. Today I'm moving to answer question number 3, Advanced Financial Management, the paper that was done in April 2022. Question 3A, I read, Modigliani and Miller suggested that real-world considerations, primarily institutional constraints on high leverage, would prevent firms from approaching 100% debt levels required. Giving reasons, explain whether you agree with the above statement. Question 3A. April 2022, question 3A. Reasons. So, is it true that, the question is it true that firms would be prevented from approaching 100% debt levels? We know that debt is a cheap cost of finance to most companies. the question is, if debt is cheaper than the other sources of capital, then why is it that most companies' capital structure do not contain 100% debt finance? There are reasons why that is the case. Giving reasons, explain whether you agree with the above statement. I agree with the above statement, and these are the reasons. The first reason why companies do not have 100% debt levels is because of the debt covenants. All right? Debt covenants. Number one, debt covenants. Debt covenants. Now, lenders may restrict a company through debt covenants, resulting to decision inflexibility. Before a company borrows, there could be a condition that the leverage of a company be, say, 50% or less. That is a restriction. Before you get more funding, financial institutions would want to check your leverage level before they advance more debt. So that could be the one reason why companies do not have 100% debt levels. The second reason is that is in relation to risk. Risk. Now, the managers that are risk averse may be reluctant to borrow more debt. Risk averse managers. Risk averse managers may be reluctant to do what? To borrow more debt. We know some managers are aggressive, they will go for more debt, but others could be risk averse, they would avoid debt. So that, because of that attitude of being risk averse, then that can limit companies to have 100% debt levels. The other reason may be in relation to the lenders. Lenders may also be reluctant to lend too much. Why? Because the company becomes riskier as more debt is borrowed. The lenders may be reluctant to lend too much debt, since company may become riskier when more debt is borrowed. So these are reasons. Any two would earn you the 4 marks. Any two reasons here, 1, 2, would earn 4 marks. Now, moving on to part B of the question. Part B reads, an unlevered firm operates in a perfect market and has a net operating profit of 4 million shillings. The required rate of return on assets of this firm is, in this industry, is 16%. Assume that the firm issues 10 million shillings worth of debt with a required rate of return of 14.5% and uses the proceeds to repurchase outstanding shares. There are no corporate or personal taxes required. Roman 1. The market value and required rate of return of this firm's shares before the repurchase transaction according to MM proposition number 1. 2 marks. Part B. Roman 1. we are to calculate the market value of this farm and the required rate of return, two things. So the market value of the farm, we know the formula is EBIT over the cost of equity. EBIT over the cost of equity. And this is the cost of equity of the unlevered farm. This farm is unlevered. All right? And therefore, the earnings before interest and tax is 4 million. The cost of equity is equal to the required rate of return, which is 16%, 0.16. So that will be the market value of this farm, 4 million divide 0.16, it's 25 million. That is the market value of this farm. The next requirement is the required rate of return. The required rate of return of these farm shares before the repurchase. The required rate of return. The required rate of return. The required rate of return. The required rate of return of the farm shares. The required rate of return of the farm shares. The required rate of return. Required rate of return is equal to W, the weight of KE, plus the weight of KD. There are no taxes. All right, there are no taxes. So candidate, the required rate of return of an unlevered farm is the same as the the weighted average cost of capital. So the weighted average cost of capital will be equal to the weight, which is 25 over 25. This is the weight. There is no debt. So 25 times 25, the cost of equity is, we read the cost of assuming the farm issues that required rate of 14, this is 16 plus 0. This will be equal to 16%. So the required rate of return of an unlevered farm is equal to the weighted average cost of capital, which is equal to the weight of cost of equity plus the weight of debt. But since the farm is unlevered, there is no debt. That's why I've put here 0, and therefore the weighted average cost of capital of this farm is 16%. Now moving on to part 2 of the question, the market value and required rate of return of this farm's remaining shares after the repurchase transaction according to MM Proposition 2. So the market value, this is Roman 2, the market value, or let me just say the value of the farm will be equal to the value of equity plus the value of debt. Value of equity plus value of debt. the value of equity plus the value of debt. Now, the value of equity is, after repurchase, is 15 million. And the value of debt after repurchase is 10 million, which is equal to 25 million. Because we read that assuming the firm uses 10%, 10 million worth of debt with the required with the required rate of return of 14%, and uses the proceeds to repurchase outstanding shares. So the value of the firm is still equal to 25, is the value of the firm. The next part we need to answer is the required rate of return. That is the cost of equity of a levered firm. This firm is levered because there has been introduction of debt in the capital structure of this company. This will be equal to the cost of the unlevered firm plus the cost of the unlevered firm minus the cost of debt times the debt equity ratio. The cost of unlevered firm, we had calculated it here, 16% plus 16% minus cost of debt 14.5% from the question times the debt equity ratio. The debt is 10 million, equity 15 million. This is equal to 16 minus 14.5 times 10 divided by 15 plus 16. So this gives me 17%. So 17% is the cost of the levered firm of this company. Now moving on to part C, I read, summarize 4 disadvantages